Hello, everyone. Welcome back, and thank you so much for tuning in again. Your support and enthusiasm mean the world to me, and it's what keeps us all inspired on this journey of growth and learning. Whether you're here to refine your trading mindset, sharpen your skills, or simply enjoy the insights of this audiobook, I'm thrilled to have you along. Let's dive back in, absorb some valuable lessons, and keep moving forward together. Happy listening, and thank you for being part of the Trading for Life community.
Part 3. Developing a trading system. Designing a trading system that fits you. Jack Schwager's primary conclusion in the first two Market Wizard books is that all great traders develop systems that fit who they are. I tend to agree that this is one of the secrets to success. Here are some of the criteria you might want to think about in designing a system that fits you. 1. You need to know who you are. How can you design something that fits you if you don't know who you are? 2. Once you know who you are, you can determine your objectives and design a system to fit those objectives. 3. What are your beliefs about the big picture? And to what extent must your system be able to fit those beliefs? For example, if you believe that the US dollar is doomed to collapse over the next 5 to 10 years, how will that affect your thoughts about developing a trading system? If you believe we are in a long-term bear market, how will that affect your thoughts about trading systems? And will you be able to trade well, even if you are wrong about the big picture? 4. You can trade only your beliefs about the market, and so you need to understand what those beliefs are. What specifically do you believe about the market, and how does that give you an edge? When you understand these criteria, you can design a specific system with which you are comfortable. Let's take a look at an example of a belief. Suppose you believe that markets are not really random, because there are big trends that don't fit the price movements you'd expect in random markets. You perhaps believe that the best way to make money in the markets is to find and capitalize on those trends. If this were your primary belief, do you think you could do the following? Buy things that are out of favor, things that nobody likes? Probably not, because this doesn't fit the primary belief that you believe gives you an edge. Sell high and buy low the way a band trader is likely to do? Probably not, because that is a very different mentality. I could give lots of examples of beliefs, and lots of examples of things that might be hard for you to do, because they don't fit those beliefs. I hope you've gotten the idea by now. You must determine what you believe about the markets that will give you an edge, because you can trade something easily only if it fits your beliefs. 5. Next, you must understand the various parts of a system and the beliefs that you have about each of those parts. For example, what do you believe about setups, entries, stops, profit-taking, and position-sizing strategies? Again, you can comfortably trade only your beliefs. For example, suppose you want to catch trends but believe in tight stops. This means that you easily could get whipsawed in and out of trades a lot, but that when you do catch a big trend, your total reward will be many times your initial risk. 6. One of my beliefs is that a trading system is characterized by the distribution of R multiples that it generates. R refers to the initial risk in a trade, and R multiples refers to the profits and losses expressed as a ratio of that initial risk. We'll discuss what that means in much more detail shortly. The distribution of your R multiple trade results will have a mean and a standard deviation that tell you a lot about how easy it is to trade your system. Thus, you must decide what kind of mean and variability a system's R multiple distribution must have in order for you to be willing to trade that system. 7. You must also ask yourself, what other criteria must my system meet for me to be able to trade it comfortably? Although I can give you lots of suggestions, this is still a matter of personal comfort and a big part of developing a system that fits you. Here are some sample criteria. Does the system fit my beliefs? Do I really understand how the system works? Do I understand how the system will perform in various market types? Do I trust my initial testing of the system? Do I feel good about trading it? Do I feel confident that I can trade it easily in my schedule without making any mistakes? 8. You also must ask yourself, how can I use position sizing strategies to meet my objectives, and what is the probability, given the system's R multiple distribution, that I will be able to do that? If you have an accurate sample of R multiples, you can probably answer this question through simulations. Finally, you must ask yourself what you will do to make sure your system fits all these criteria well enough for you to be comfortable trading it. If it doesn't meet some of your criteria that well, what will you do to make it fit? Or will you change your criteria? Trading concepts. There are many different types of traders, and one way to classify them is by the basic concept that they trade. Some concepts are diametrically opposed, for example, trend following versus band trading. But you can trade any of them if you believe in it enough and practice low-risk ideas. Trend following. The basic idea here is that you buy what's clearly going up and sell it when it stops going up. Similarly, you sell short what's clearly going down and buy it back when it stops going down. The key to doing this is to have a method by which you define when to enter and exit that gives you low-risk trades. Fundamental market analysis. The basic idea here is based on the supply and demand concept in economics. You need to analyze the market to find out where demand may exist and buy there, ideally before it occurs. When you think the price is high enough that demand may drop off, you sell. You could assume that when the supply is low, demand will increase and start the market moving, but that isn't always the case. Let me give you an example in an area that I know well: rare U.S. stamps. Certain 19th century stamps were issued in a very limited supply, and fewer than 100 are known to exist today. However, there isn't much demand for these stamps, and so the prices are pretty reasonable. However, if just 50 collectors were willing to spend $100,000 on very rare U.S. 19th century stamps, the prices would go up tenfold or more. Value trading. You buy things that are way undervalued, assuming that one day the market will catch up with their value. There are probably thousands of ways to value stocks, and some are more useful than others. If you decide you like value trading, your job is to find one of the more useful methods. Band trading. Certain instruments, stocks, commodities, and currencies trade in bands. You buy something when it touches, crosses, or gets close to the lower band, and sell it when it does the same thing for the upper band. It doesn't matter which order you do this in. The key to band trading is to understand how to develop useful bands. Seasonal tendencies. Perhaps the real key to understanding seasonal tendencies is that what you find must have a fundamental basis for its existence. You can always use a computer to find meaningless correlations. For instance, say you buy XYZ in the last week in March because it went up for the next 3 days in 18 of the last 20 years. That could easily be a statistical fluke. What you are looking for is something like this. The stock market tends to go up between November and May because pension money tends to pour into the market during that period. Spreading. This really gets into the realm of the professional traders, who can create long and short positions with a lot of potential to move, but with a much lower risk profile. For example, you can buy a December option and short the March option. You can buy one currency and short another. These are common practices among professionals who can do large trades very cheaply. Arbitrage, practiced primarily by professionals. Here you find a loophole in the way things are done that gives you a huge edge. For example, before currency trading was available, one of my clients discovered that he could buy sugar in London in sterling and buy it in New York in dollars. He would spread the two markets to trade the dollar-sterling relationship, and he was the only one doing that. He said that in those days he'd have to unload one of his spreads if anyone wanted to trade sugar. Of course, this situation didn't last too long because people figured out what he was doing, but while it lasted, he said, it was like taking candy from a baby. The secret to arbitrage, of course, is to be able to find the loopholes and figure out how to capitalize on them. Intermarket analysis. Here we make the assumption that the price of one commodity, or product, is a function of what many other commodities are doing at the same time. It's not just a simple relationship among a few things. Thus, gold may be related to the price of oil, silver, the dollar, and a number of other currencies. These relationships change over time. Thus, the key to trading this concept is to evaluate a number of different inputs simultaneously to find the relationships that currently exist. Of course, this just lets you know the current relationship. You then have to use the key low-risk concepts common to all systems to make money from the relationship. There is an order to the universe. Here there are a number of sub-concepts, including 1. Waves of human emotion, 2. Physical events that may influence human behavior, and 3. A mathematical order to the universe. All these concepts can be traded if they fit you, and you use the appropriate low-risk techniques. All these concepts describe the reasoning for trade setups that one might look for in the market. Setups are a small part of trading, but because people think that picking the right investment is so important, these types of concepts were developed. Trading styles actually are named after the setups. Setups are not as important as you think. I noticed at the beginning of my career as a trading coach that when people talked about a trading system, they really were talking about the setup to a system. Setups are a very small part of what is necessary for a complete trading system, yet people still claim their setup conditions are their systems. When you see the setups in a stock, you have an increased probability that the stock will go up. but it is through position sizing strategies and managing the ratio of reward to risk throughout the trade that produces the great profits in the trade. Let's look at one of the most famous systems around, William O'Neill's CANSLIM system. What is CANSLIM? It's an acronym for O'Neill's setups. Current quarterly earnings, annual earnings increases, new product, new management, supply and demand, leader or laggard, institutional sponsorship, and market direction. When people talk about CANSLIM, they mostly discuss what each of the letters stands for in some detail. However, the CANSLIM setups, in my opinion, are the least important aspect of what makes that system successful or unsuccessful. The following is a brief discussion of some of the setups you might want to consider. 1. Failed test setups. These setups occur when the market wants to test some area. For example, the turtles used to trade 20-day breakouts, and so a 20-day high is considered a test area, and its failure to continue is what might be called a failed test setup. 2. Climax reversal setups. Here the price goes parabolic to a new high and then falls. These setups are often the start of big moves in the opposite direction. 3. Retracement setups, often used by trend followers. Here the market is identified as being in a clear trend, the first part of the setup. Then it reverses for a short while, the second part of the setup, and then the trend continues. 4. Time setups. These occur when you think that some move is due at a particular period as a result of some mysterious order to the universe concept. If you have one of these, the time at which the setup is about to occur might be considered the setup. 5. Price data in sequence setups. I gave an example of this in the description of the retracement setup above, but there are many different kinds. 6. Fundamental data setups. For example, an analyst may conclude that there is pent-up demand for a commodity. Demand usually means there is a potential for the price to rise, and so the decision that demand is rising might be considered a setup. 7. Volume data setups. For example, the ARMS index, which involves volume data, might be considered a setup. 8. Component data setups. If you are trading an index, such as the S&P 500, you could find important information that suggests a move by looking at what some of the individual stocks are doing. That's just one example of component data. 9. Volatility setups. When volatility contracts extensively, it's often comparable to a spring waiting to uncoil, and thus could be considered a setup. 10. Volatility breakouts. When volatility is suddenly very large, it usually signals the end of a move or the beginning of a new move in the opposite direction. 11. Business fundamentals setups. Value investors have different ways to determine when a stock is undervalued, and that usually is a setup for them to buy. Warren Buffett has a number of business fundamentals that he reviews about each stock before he buys. These are all examples of what might be called business fundamentals setups. 12. Overbought or oversold setups. When the market is overbought in the short term, swing traders sometimes get a good short-term high reward to risk short trade. Similarly, when the market is oversold, they often get a good short-term high reward to risk long trade. Entering the market. Tom Basso and I were giving a systems workshop, but we were emphasizing the importance of psychology, exits, and position sizing strategies. Someone in the workshop said, "I suppose you could make money with just a random entry." Tom said he hadn't thought about that, but he went home and tested his exits and his position sizing method with a random entry system, and sure enough, it made money. I was fascinated by the idea and decided to prove it for myself. I designed a system that traded 10 commodities over a 10-year period from 1983 to 1992. It was always in the market on all 10 positions. When it exited, it needed to re-enter immediately long or short on the basis of a coin flip. My exit was 3 times the average true range of the last 20 days, and I risked 1% of my $1 million account per position. It required a $1 million account to always be in the market in 10 futures positions. I also added in $100 for slippage and commissions for each position, and so I had to overcome a huge amount of costs plus random entry. With random entry, you are giving up any advantage that a particular entry has. The only way you can make money is to catch a strong trend occasionally and make sure that your losses are not too big and that you practice proper position sizing strategies. My results agreed with Tom Basso's. The method made money consistently. It didn't make a lot of money, and you would have to live through some nasty drawdowns, but over the 10 years it made money. Why do people make a fuss about entry? I touched on this in talking about setups. People are brainwashed to think investment or trading success is all about picking the right stock. It's not. Let me tell you about the first stock I bought when I was 16. I found the stock that had the highest per-share earnings growth the prior year, according to the 1961 Review of the Year by Fortune magazine. Thus, there was some research involved in my decision but no particular entry. Once I discovered it, I bought 100 shares for $800. That was my entry. I then watched it go up to $20 per share and then go back down again. Eventually, it went to zero. My understanding is that a lot of people go through this sort of experience. You could say that I bought the wrong stock. I could have bought Microsoft or Berkshire Hathaway in their infancy and made a fortune with my $800. However, for every stock like that, there are 1,000 that eventually disappear, including many Fortune 500 companies. I basically ignored every important rule that I now teach people, simply because I thought that to be successful I just had to pick the right stock. I could have had a 25% trailing stop. In that case, my initial risk would have been $200, a 25% drop. When the stock reached $20, a 25% trailing stop would have had me sell at $15. I would have made $700 for a 3.5R profit. I didn't pick the wrong stock, I just didn't understand the rules for making money. Let me repeat that statement. Success is not about picking the right stock. Of the original 30 Dow Jones Industrials, only one remained in 2009, General Electric. Most were dropped from the index, went bankrupt, or were absorbed by another company. That eventually happens to most companies. Picking the right stock and holding it until you die is not the magic formula for success unless you are very, very lucky. However, today many people have this sort of bias. They are looking to pick the right stock and figure out how and when to buy it. For those of you with that interest, Chapter 9 of the second edition of Trade Your Way to Financial Freedom has everything you need to know about entry. I discuss channel breakouts, moving averages, pattern recognition, prediction, volatility breakouts, oscillators, and more because so many different entry signals have been developed over the years. The key is to make sure you don't think it's the most important part of your trading, because it isn't. As we've already proved, you can make money trading with a random entry. The source of the stock selection myth. Since most people believe that stock selection is the key to making money, I'd like to share with you the source of that myth. Mutual funds. Mutual funds by charter are supposed to be fully invested. Furthermore, their job is not to make money but to outperform the market, which most of them cannot do. They cannot outperform the market because they generally invest in their benchmark index, for example, the S&P 500, and charge you fees to manage your money. If you must be fully invested, you cannot really practice position sizing strategies or proper risk control. Even asset allocation, which is actually a position sizing method, seems like an exercise in deciding which assets to invest in at any specific time. Mutual funds, by the way, don't get paid for performance. They get paid by the amount of assets they manage. In other words, they get paid if they keep your money. When the market goes up, most funds make money, and most people are happy to be a little richer. The fund managers go on CNBC and talk about which stocks they like. When the markets go down, most funds lose money. Most people don't understand that the best traders get out of mutual funds and become hedge fund managers so that they can really trade. Very little of what hedge fund managers do involves stock selection. It has to do with cutting losses short, letting profits run, and practicing proper position sizing strategies to meet their objectives. Improving on random entry. For swing and day trading, measures of being oversold or overbought are pretty good setups. One of the better oversold reactions is 5 days down. When the market or a stock has been down 5 straight days, it is due for an upward correction. However, the ideal entry is when you get some movement in your favor and can set up a high reward to risk trade. When the stock makes a new high, or perhaps if you want more confidence, 3 new highs, could be hourly or daily bars, you would set your stop just below your swing low. This would be your initial risk, or 1R. Ashton Dawkins and Larry Connors found that stocks that closed down for 5 consecutive days outperformed a benchmark index by 0.63% a week later, which suggests some edge for such a setup. This would improve further if the stocks were above the 200-day moving average. Of course, they had no stop. These stocks might lose much of their edge with a stop. But what if you have a profit target, such as the prior high before it started going 5 days down? How many points of movement is that away from your entry? Figure 3:1 shows such an entry at $61.60 at the close. After an even better setup of 6 days down, in which the initial risk, to the prior day's low, is about 90 cents. The potential reward is the high 7 days ago of $67. So there is a potential gain of $5.40. Thus, the reward-to-risk ratio of this rate is 6 to 1. Even if it reaches only $64, where there is some potential resistance, the reward-to-risk ratio is still 2.67 to 1. Thus, not only do you have an edge for this stock to outperform its benchmark index, you also have the potential of a 6 to 1 reward-to-risk ratio if you are correct. That's what I call an improvement on random entry. We'll look at how this could be traded with exits later in this section. See page 169. Exits are the keys to making money. As I mentioned earlier, I proved to myself that one can make money with random entry. When you employ random entry, you are giving up any advantage that your particular setup and entry edge have. The only way you can make money is to catch a strong trend occasionally, make sure your losses are not too big, and practice proper position sizing strategies. How can your exits help you catch a strong trend? In a random entry system, when you exit, you'll enter back into a trade again and lose another $100 in slippage and commissions. Thus, you want your initial exit to be large enough to make sure that you don't exit very often. At the same time, you don't want to enter into a trend in the wrong direction, which would cause you to pile up huge losses. Thus, to make the random entry system work, I needed an initial stop that was big enough to keep me in the market while it was just making random noise movements or moving sideways. I chose to exit at 3 times the 20-day volatility or average true range. I like to keep things simple, and so I made the abort exit and the profit-taking exit very similar. I trailed 3 times the 20-day average true range from the closing price. Thus, if the price moved in my favor, so did the trailing stop. And if the volatility shrank, the stop also would move in my favor. The stop was moved only in my favor, never against me. As a result of this exit, I was able to stay in sideways markets for a long time and not get stopped out. If I entered against a trend, I was stopped out quickly and hoped the random entry would re-enter in the direction of the trend. Also, if I was lucky enough to enter in the direction of the trend, my stop kept me in the trend for a long time. It was that easy. With that simple exit, the random entry system was able to follow the golden rule of trading, cutting losses short and letting profits run, and thus make money overall. The first kind of exit you need to know about is the abort exit. This is the exit that defines your initial risk, or what I've been calling 1R. In reality, there are 2 kinds of initial exits. Tight ones. 1R is small, much like our earlier example of 46 cents for the SLB trade, and wide ones. 1R is big, like the 3 times ATR for the random entry system. Each has some distinct advantages. The wide exit keeps you in a trade for a long time and gives it a chance to start working for you. Thus, if you like to be right and you want to stay in the trade a long time, you have more of a chance with a wide exit. Examples of this include the 3 times volatility exit mentioned for the random entry system and a 25% retracement exit, which works fairly well for stocks. If you want to buy and hold stocks as long as you can, simply use a 25% trailing stop as an exit, adjusting it up whenever the stock makes a new high. The other type of initial exit is the narrow exit, which defines 1R as a very small amount. If you want to be right and stay in the trade a long time, you don't want this sort of exit because you'll be stopped out a lot. Your stop is usually within the noise of the trade, so you'll be stopped out within a day or 2. However, if you want large R multiple gains and are willing to trade short term, you'll find some advantage to tight initial exits. Let's look at an example. Suppose you buy a $50 stock when it breaks out from a consolidation with power. If you put your stop below the consolidation, say at $45, you'll probably be right a lot. However, if the stock goes up $10 in price, you will have made only twice your risk, or 2R. Suppose you put your stop in at $49, a dollar away. If the move has power behind it, the stock should keep moving and you won't be stopped out. Furthermore, if the stock goes up $10, you've now made a 10R profit, or 10 times your initial risk. In fact, you could be stopped out 3 times in a row, getting 3 1R losses, and then make your 10R profit. You are right only 25% of the time, but your total profit is 7R. At this point, you might be thinking, yes, you make 7R, but you started out with a very small risk. That's where position sizing algorithms come into play. What would happen if you risked 1% of your account on every trade? If you are up 7R, you'll be up about 7%, no matter how big or small R is for 1 unit. Exiting a trade beyond the initial stop. When you design an exit for your system, one of the key things to consider is the purpose behind that exit. You might have 5 possible purposes for an exit. 1. Produce a loss but reduce the initial risk. 2. Maximize the profits. 3. Keep you from giving back too much profit. 4. Maintain a reward to risk level of at least 1 to 1. 5. Psychological reasons. Rather than cover each of these exits, I'll focus on one particular goal and show you how to use exits to meet that goal. Let's say your goal is to follow a trend as long as it lasts. However, you want to have a wide initial stop so that you won't be whipsawed once you get into the market. You also want to give the position plenty of room to move. Finally, you want to capture as much of your profit as you can once you reach a 4R target. Note how these objectives fit a particular set of beliefs about the market. Your system always has to conform to your beliefs about the market, or you won't be able to trade it. To meet your initial goal, you need a wide stop. Let's say you pick 3 times the volatility of the last 20 days, as I described for my random entry system. That gives you plenty of room to make sure that the random noise of the market will not take you out of your position. Second, you want to give your position plenty of room to move as it is going up. Again, all you have to do here is trail your 3 times volatility stop to meet this objective. Thus, every time you make a new high, your stop will move up to trail from that point. Third, once you've reached 4R, you don't want to give much profit back. Thus, you decide that when your target is reached, you will shrink your stop from 3 times the volatility to 1.6 times the volatility. It's that simple. Your worst case at this point is that the market will retrace immediately, and you will get stopped out. However, your new stop is probably only about 0.5R now, and so if you were immediately stopped out, you'd still have about a 3.5R profit. Of course, the market could continue to climb, and you are giving yourself a chance for a 10R profit or more. All these stops are simple. I came up with them just by thinking about the types of stops that you might want to use to meet the stated objectives. No testing was involved, and so they are not over-optimized. No rocket science is involved. They are logical and make sense for meeting the objectives. They are simple. Note that you also have 3 different exits, but that only one will be active at any one time, the one that is closest to the market price. If you want to master exits for your trading system, you must learn the different types of exits available to you. Notice what each exit is designed to accomplish. Then, when you decide how your system is supposed to work, you'll find it easy to develop an exit that meets your goals. Remember that your real goal in designing a trading system is to develop one that works well in 1 or 2 market types. That's pretty easy to do. As mentioned elsewhere in the book, the mistake most people make is to try to fit one system to multiple market types. You don't have to do that. Start thinking in terms of reward and risk. One of the cardinal rules of good trading is always to have an exit point before you enter into a trade. This is your worst-case risk for the trade. It's the point at which you would say something's not working with this trade and I need to get out to preserve my capital. Most sophisticated traders have some sort of exit criteria that they like. However, if you are a novice and don't know how to do this, I recommend 75% of your entry price if you are an equity trader. That is, if you buy a stock at $40, get out if the stock drops to $30 or below. If you are a futures trader, calculate the average true range over the last 20 days and multiply that result by 3. If the contract drops to that level, you must get out of the position. Your initial stop defines your initial risk. In the example of our $40 stock, your initial risk is $10 per share, and I call this risk 1R, where R stands for risk. If you know your initial risk, you can express all your results in terms of your initial risk. Say your initial risk is $10 per share. If you make a profit of $40 per share, you have a gain of 4R. If you have a loss of $15 per share, you have a 1.5R loss. Losses bigger than 1R could occur when you have a sudden big move against you. Let's look at a few more cases. If the stock goes up to $110, what's your profit in terms of R? Your profit is $100, and your initial risk is $10, and so you've made a 10R profit. This is interesting because portfolio managers like to talk about 10-baggers. By a 10-bagger, they mean a stock that they bought at $10 per share that goes up to $100. In other words, a stock that goes up in value 10 times. However, I think a 10R gain is much more useful to think about and much easier to attain. When our 1R loss was $10 per share, The stock had to go up by $100 to get a 10R gain. However, to fit the portfolio manager's definition of a 10-bagger, it would have had to go up 10 times the price you bought it for, rising from $40 per share to $400. What would that $360 gain be in terms of R multiples when your initial risk was $10? That's right, it would be a 36R gain. As an exercise, look at all your closed trades last year and express them as R multiples. What was your initial risk? What was your total gain and total loss? What's the ratio of each profit or loss to the initial risk? If you didn't set your initial risk for your trades last year, use your average loss as a rough estimate of your initial risk. Let's look at how 8 trades might be expressed as ratios of the initial risk. Here we have 3 losses: $567, $1,333, and $454. The average loss is $785.67, and so we'll assume that this was the initial risk. I hope you know the initial risk so that you won't have to use the average loss. The ratios that we calculate are the R multiples for the trading system. This information is shown in Table 3:1. When you have a complete R multiple distribution for your trading system, there are a lot of things you can do with it. You can calculate the mean R multiple. The mean R multiple, what I call the expectancy, tells you what you can expect from your system on the average over many trades in terms of R. Although I recommend that you have a minimum of 30 trades before you attempt to determine the characteristics of your R multiple distribution, we'll use the 8 examples in the table. Here the mean R multiple is 0.68R. What does this tell you? The expectancy tells you that on the average you'll make 0.68R per trade. Thus, over 100 trades, you'll make about 68R. The standard deviation tells you how much variability you can expect from your system's performance. In the sample, our standard deviation was 1.86R. Typically, you can determine the quality of your system by the ratio of the expectancy to the standard deviation. In our small sample, the ratio is 0.36, which is excellent. After 100 or so trades, I'd expect this ratio to be much smaller. However, if it remains above 0.25, we have an acceptable system. Thinking about reward and risk throughout the course of a trade. Recently, I consulted with a fund manager who was a strong fundamentalist. He was really good at predicting when a strong, fundamentally based trade would start, and he was good at knowing at what price he was wrong about the trade. However, in my opinion, those were the only major things he had going for him. He didn't understand reward to risk, and he didn't understand the impact of position sizing strategies. He predicted that if the Singapore dollar dropped below $1.80, it was at $1.85, it would move to $1.20 over the next 10 years. Thus, he would be risking 5 cents for a potential move of 60 cents, or a 5-to-1 reward-to-risk ratio. However, when the Singapore dollar reached $1.35 in early 2009, his stop was still at $1.80. Now he was risking 55 cents for a remaining potential move of 15 cents. His reward-to-risk ratio was now 1 to 3.67, with his risk being more than 3 times his reward. And when he gave back 20 cents, his investors were shocked, even though he insisted he was still right about his prediction. He didn't understand that he should never let his reward-to-risk ratio fall below 1-to-1 throughout the trade. Figure 3-2 shows what he should have done. When the price dropped below $1.70, he should have lowered his stop to break even. Then he would have been risking only 10 cents of profit to make 50 cents. Keeping his original stop would have given him a 3-to-1 reward-to-risk ratio. When the price formed a bottom at about $1.60 and started moving up, he should have moved his stop to $1.73. He then would have been risking 13 cents in profits to make an additional 40 cents, and still would have had a 3-to-1 reward-to-risk ratio. When the price moved to about $1.55, even though it was still moving down, he had a nice profit, and should have locked in about half of that profit by putting his stop at about the $1.65 level. He would have been risking 10 cents to make 25 cents, still a good reward to risk. But at this point, he would have locked in a 1.5R profit. After the Singapore dollar formed a base at about $1.55 and started moving down past $1.45, he could have lowered his stop to $1.56, risking 11 cents to make 25 cents, which was still better than a 2-to-1 reward-to-risk ratio. When the price hit $1.35 and started moving up, he could have lowered his stop to $1.45. He then could have had a profit potential of 15 cents and a risk of 0.10, which was still favorable. He would have eventually been stopped out at this level, but he would have locked in a profit of 35 cents or 3.5 R.3. Had he kept his original stop, he would still be in the trade, but he would have been risking 40 cents to make 15 cents, which doesn't make sense. In addition, he would be at risk of giving back a profit that had taken 6 years to accumulate. That's why you should think in terms of reward-to-risk ratios throughout the course of your trade. Thinking about the reward-to-risk ratio as the exit in a swing trade. In Figure 3:1 on page 168, I showed you the trade in SLB after 6 days down, with a 6-to-1 potential reward to risk. So what would happen in that trade if you kept the reward to risk in mind as an exit throughout the trade? For example, each day the trade opened higher. Thus, you could have put your stop under the low of the prior day. This would have meant that even after day 1, you would have had a small profit locked it. You can see from Figure 3:3 that this could have been done in this example. What if the price didn't go up each day? You'd keep the stop at the same point until the price reached a new high, and then raise your stop. And in each case, you'd be locking in more profit and still be giving yourself at least a 1-to-1 reward-to-risk ratio for the remainder of the trade. Furthermore, the worst reward-to-risk would be at the final day, when your stock closed at its target price. If you wanted to allow for the potential that it would move higher, your risk would be just under the prior day's low of 66.85. You'd have a risk of 1.15 points for the potential of a higher gain. You'd have been stopped out the next day. Your other alternative would have been to take off the position as soon as the target was reached. One of your most important tasks: keep up with the R multiples of your trades. One of the easiest ways to keep track of the R multiples in your trading system and its expectancy is to calculate them on a daily basis. Keep a daily spreadsheet with some simple information on it. You need only 5 basic columns. 1. An identifier column, what trade it was and when it was purchased. 2. Your entry risk, the difference between the entry price and the initial stop times the number of shares purchased. 3. How many shares or contracts. 4. The total gain or loss when you sold the stock. Yes, you can subtract commissions. 5. The R multiple, column 4 divided by column 2. You might want other columns, such as the entry price, whether you are long or short, the exit price, and the percent risk taken on the trade. However, these columns are not critical to obtain the R multiples and the expectancy of your trades. When you do this kind of exercise, you gain important information. First, you are forced to write down and know your initial stop. There is no cheating when you do this. You must know the initial stop. This exercise alone will save you money. It will force you to have an initial stop and show you whether you are paying attention to it. If most of your losses are less than 1 R, you are paying attention. If most of your losses are more than 1 R, you are not paying attention to the stop, or you are trading instruments that are so volatile that you cannot possibly expect to get out at those stop levels. The second thing this exercise forces you to do is define what 1 R is in each trade in the simplest way possible. You're asking yourself, what is my total worst-case risk going into this trade, and writing the answer down on paper. Again, this value is the entry price minus the stop price, multiplied by the total number of shares purchased. Here 1 R is confounded with the position sizing method, but it also is in the profit and loss, and so the position sizing method cancels out. Third, this exercise forces you to calculate the R multiple for each trade. When you close out the trade, you compare it with the initial risk. Is it bigger or smaller than the initial risk, and by what magnitude? This information is very valuable. Fourth, this process forces you to start thinking about the reward-to-risk ratio in each trade you make. You begin to learn that you should never take a trade unless the potential reward is at least 3 times as big as the potential risk you face. And the reward-to-risk ratio should continue to be no worse than 1-to-1 as the trade progresses. Fifth, this exercise provides an easy way to calculate the expectancy of your system on an ongoing basis. You simply add up the R multiples for all your trades and divide the total by the number of trades. The resulting value is the current expectancy of your system. By doing this exercise, you'll know where you stand every day. You'll know the expectancy of your system, how much you'll make per trade on average as a function of your initial risk, and know why it changes. For example, when I asked one of my clients to send me a spreadsheet of his scalping trades, It became clear to me that his trading was not at all as he'd described it. Those trades are shown in Table 3-2. In addition, the R multiples are sorted in Table 3-3. For example, his system had 60% winners and risked a few cents per share on 1,000 shares to gain a few cents per share on those shares. In other words, his 60% system had winners and losers that were both about 1 R. The fact that he didn't know the distribution of his R multiples, as most traders don't, shows why this is such an important exercise. Although he was right about the system being correct 60% of the time, he was wrong about the R multiple distribution. Half his profit came from a single trade, Trade 7. Although only 40 trades were given in the sample, I expect that this was typical of his trading. Another interesting aspect of his trading was 4 consecutive losses, all of which were 1.5 R or bigger. He also had 6 losses in 8 trades. This is another nasty contingency that one may have to contend with while trading such a system, even though the system has a reliability of 60%. In addition, he had a number of losses that were 2 Rs or more. I tend to suspect that many losses that big are psychological mistakes. Eliminating those mistakes is very important to doing well in trading. You can plug all of these R multiples into a simulator, such as the one that comes with my position sizing game, and start simulating what real trading would be like. Doing this can give you a lot of good information about what it is like to trade this system. Exercise. Make a table similar to Table 3-3. For each trade you make, put down your worst-case risk at the outside. How much would you lose if you were stopped out? This amount defines 1 R for you. When you sell the position, write down the total profit or loss for you. Divide this figure by 1 R, and you will have the R multiple for the trade. On an ongoing basis, sum your R multiples and divide by the number of trades. This will give you an ongoing expectancy for your system. Notice how each trade affects it. Overall, I would recommend that you collect 100 to 200 trades like this. At that point, you will have a good idea about the expectancy of your system. In addition, you will have a fairly accurate picture of the distribution of R multiples in your system, allowing you to simulate it. Remember to look at market type, and take trades only for the market type for which your system is designed. 6 keys to a great trading system. As people study trading, most of them are exposed to a lot of misinformation. It's almost as if there were an intelligence agency putting out misinformation to make sure that the average person cannot trade profitably. Thus, it's very important for you to understand the 6 factors in great trading. 1. Reliability. What percentage of the time do you make money? Most people emphasize this. They want to be right on every trade because they were taught in school that 70% or less is failure. However, you can be right about 30% of the time and still make good money. 2. The relative size of your profits compared with your losses. We've already discussed thinking about your trades in terms of R multiples. You want your losses to be 1 R or less, and your profits to be large multiples of R. This is essentially the golden rule of trading. Cut your losses short and let your profits run. It's one of the keys to success, but it is very hard for most people to do. 3. The cost of your trading. When I first started trading, it cost about $125 each time one got in and out of the market. Trading costs were atrocious. Now you can get in and out for as little as a penny per share. However, trading costs still can mount up in an active account. Several years ago I was trading very actively. I was up about 30% on the year, and I noticed that my trading costs totaled more than my profits. Thus, even with today's massive discounts, it can still cost a lot to trade. 4. Trading opportunity. For example, if you can make an average profit of 1 R per trade and you make 50 trades per year, you'll be up 50 R. However, if you can make that trade 500 times, you'll be up 500 R. 5. The size of your trading capital. When your account is small, it's very difficult to make good returns. But when your account gets to a decent size, making good returns becomes much easier. Some accounts are just too small to trade. The reverse also occurs. When your account is so big that you can move markets just by entering or exiting, it becomes much more difficult to make good returns. 6. Position sizing strategies. Position sizing strategies tell you how much to risk throughout the course of a trade. It is probably responsible for 90% of your performance variability. That's how important it is. Most people want to be right most of the time. However, you can be right 99% of the time and still be wiped out in any of the following scenarios. 1. You don't have enough money to trade, and the one time you were wrong you were wiped out. 2. Your position size is too big, and the one time you are wrong, you are wiped out. 3. One loss is so big, regardless of your position sizing method, that it wipes out all your profits. Perhaps you have small stops, and your loss is a 100R loss. Common elements of success. Most people don't realize that at any particular time, 4 or 5 people may go long a position, and another 4 or 5 may go short or unload a position. Each of them can have different systems and different ideas, and all of them can make money. They may have different ideas about the market, but they trade it because they figured out that it is a low-risk idea. A low-risk idea is an idea with a positive expectancy that's traded at a position sizing level that can survive the worst-case contingency in the short run and realize the long-term expectancy. I would add that such ideas are low-risk ideas only if they are traded in the market type for which they were designed. All traders can make profits, even with different concepts, different systems, and some taking the opposite sides of the same position. When they all use systems with 10 common characteristics, 1. They all have a tested, positive expectancy system that's proved to make money for the market type for which it was designed. We've been discussing how that's done. This is either a mechanical system or a discretionary rule-based system. 2. They all have systems that fit them and their beliefs. They understand that they make money with their systems because the systems fit them. 3. They totally understand the concepts they are trading and how those concepts generate low-risk ideas. 4. They all understand that when they get into a trade, they must have some idea of when they are wrong and will bail out. This determines 1R for them, as we discussed previously. 5. They all evaluate the ratio of reward to risk in each trade they take. For mechanical traders, this is part of their system. For discretionary traders, this is part of their evaluation before they take the trade. In many cases, they evaluate the reward to risk ratio throughout the course of a trade, never letting it go below 1-to-1. Can you begin to see how those 5 qualities will start to generate success? However, there are 5 more qualities that are just as important, and in some cases even more important, than the ones just listed. Before moving on, reread the prior sections and see if you can determine what they might be. 6. They all have a business plan to guide their trading. I've been talking about the importance of this plan for years. Most companies have a plan to raise money. Similarly, you need a plan to help you treat your trading like a business. 7. They all use a position sizing method. They have clear objectives written out, something that most traders/investors do not have. They also understand that position sizing strategies are the key to meeting those objectives, and have worked out a position sizing algorithm to meet those objectives. We'll discuss this later. 8. They all understand that performance is a function of personal psychology, and they spend a lot of time working on themselves. This area has been my key focus for many years, teaching traders to become efficient rather than inefficient decision makers. 9. They take total responsibility for the results they get. They don't blame someone else or something else. They don't justify their results. They don't feel guilty or ashamed about their results. They simply assume that they created them and that they can create better results by eliminating mistakes. 10. This leads to the 10th key quality. Understanding that not following your system and business plan rules is a mistake. We've discovered that the average mistake can cost people as much as 4R. Furthermore, if you make even one mistake per month, you can turn a profitable system into a disaster. Thus, the key to becoming efficient is to eliminate such mistakes. The "it didn't work" mentality. One of the least productive things you can say in furthering your market research is, "It didn't work." I frequently give my clients research assignments, telling them a great area in which they can do research. I may see them again later only to find out that they are working on something entirely different. When I ask about the research area to which I had directed them, the response is usually, "It didn't work." That response totally shuts off productive research, as if there were no potential in the area at all. A much better response would be, "It didn't work because." Quote, this sort of response indicates why it didn't work, and perhaps even suggests an alternative course of action. Let me give you a few examples of how this mentality has been used to shut down very productive areas of study. One of my clients came up with what I thought was a very productive profit-taking exit. The exit started out with a wide stop, and the stop stayed wide as long as the market was moving strongly. However, when the market started to level off, or when the advance started to slow, the stop would get much tighter. The net result was that one seldom gave back much profit. Doesn't that sound excellent? I thought so, especially since his system always gave a re-entry signal if the market started to move again. However, about 9 months later this trader was into a drawdown. I asked how his stop was doing, and he said he had abandoned it. When I asked why, his response was, "It didn't work when I added my position sizing algorithm." There was no explanation why, which might have resulted in an alternative solution. Instead, the choice was simply to say, "It didn't work," and move on. I had been working with another client in developing a good system. We had discussed high R multiple trading, and he had informed me that he had a setup that could be used in the context about which I was talking. He reasoned that this setup would give him signals with profits about 5 times as big as he was risking. Furthermore, the signals made profits, he thought, about 40 to 50% of the time. I thought that the signals sounded great and suggested that he take only those signals for a while. In addition, he was to research the exact parameters of the signal and send me a daily email. What happened? He never took a single signal. Instead, he stopped sending me emails and told me that the signal didn't work. I asked him to send me data showing me why it didn't work. His response was that he'd get to it one day, but to leave him alone until he'd gotten around to it. After all, he said, I've already told you it didn't work. Once again, a potentially great idea was killed by 3 little words. It didn't work. Those are just 2 examples of dozens that I can think of, and every one of them illustrates an important point. The way you think about something can totally change your relationship with an idea. Edison was said to have had 10,000 failures before he invented a working light bulb. He may have said it didn't work after any one of them, but those words didn't stop him. Instead, he determined why the method didn't work and used that information to find another good idea. At no time did he abandon the idea permanently by saying, "It didn't work." Know when it doesn't work. When you have a system or an idea, you must know when it truly doesn't work. This is the logical extension of giving up on a good idea because you think it doesn't work. When you've researched something well enough to know, 1, you are not getting the performance you want, and 2, the reason you are not getting that performance, you've taken an important step toward knowing that something doesn't work. Usually, the knowledge of why something doesn't work will give you important knowledge about what to pursue next. For example, let's look at the idea of maximum adverse excursion, MAE, the idea that losing trades don't go too far against us. In other words, you calculate the MAE in each winning trade to see how far it went against you. This gives you an idea for limiting your stops, but when you try to apply it to your trading, you may encounter some problems. Some profit increase does occur, but it may not be that significant for you compared with the complexity of the MAE addition. Let's say you decide that MAE doesn't work for you because 1. Some losing trades exit at the MAE when they would have exited at much less of a loss if more room had been provided by a larger stop, and 2. Some big R multiple winners are cut off and become losses. Since re-entry isn't allowed, those big winners are never realized. These 2 reasons cancel the effect of increasing the potential R multiple of those winning trades. You might take this concept and decide that that's all you want to do with it. It didn't work, and you know why. That's fine. However, you also can use the reasons for failure as logical stepping points for your next research idea. For example, I noticed that in the few cases in which big R multiples are cut off, a re-entry signal almost always will catch them. When you conduct trading research and determine why something didn't work, it will always give you a reason. This reason could point you to areas that could give you much more profitable results. Trading reality check. Having modeled success in numerous areas, the trading process, the design of systems, understanding and using position sizing strategies, and developing personal wealth, I'm amazed to see how we are almost hardwired to do all the wrong things. It's as if we were put on this planet to determine how many ways, and to what extent, we can mess up our lives. How do you respond to a loss? Have you run simulations of your trading? Have you really worked on yourself and determined that it's all you? What decisions have you made about your trading and yourself? Let's look at a simple example. Knowing what you know after reading this far, you should have many ideas for how to improve your trading. Is there not a good reason to spend a month or 6 months developing a good business plan and implementing many of these ideas? Of course not. So what is stopping you? If you don't immediately feel the urge to carry out this task, it's time to do a little homework to recognize your self-defeating patterns and excuses. I'd like you to sit down and write several paragraphs on the story I'd tell myself if I did not produce meaningful change in my trading and myself. Be honest with yourself. What are your typical excuses? Here is one possible excuse. I was desperate. I was running out of money and needed to do something now. I really didn't want to go back to work, so I had to make money now. As a result, I really didn't have time to do a proper business plan. Instead, I just made trades in the market. You also have patterns of behavior, justifications for failure or not doing something, rationalizations for how you are, and so forth. So what is it? You might begin your rationalization with, after going through Dr. Tharp's Super Trader book, I did nothing toward creating meaningful change in my trading because, quote. Or your story might even be worse. After buying 20 books to improve my trading, I have not looked at any of them because. You might get away with sabotaging yourself by not making a plan, or even not determining what you need to do. However, for the 30 minutes it takes to do this exercise, give yourself a break and be brutally honest with yourself. You know that you'll con yourself in order not to make progress. Treat this exercise as a test to determine exactly how you con yourself. Can you be honest and tell it like it is, or is it more important to justify the excuses and be a failure? Do a reality check on your trading. Go ahead. Take 30 to 60 minutes right now and start writing your excuses. What did you write? If you were honest with yourself, you justified your limitations. You probably created a record that includes many of the major thoughts and beliefs you use to undermine virtually every endeavor you try. Furthermore, the more honest you've been with yourself, the more valuable this exercise will be for you. What it takes to have confidence. Here is an email I received from a client. Dear Dr. Tharp, overconfidence presents a trading conundrum. I find I can't trade big or successfully without lots of confidence. But when I'm at my most confident, the point where I lose all anxiety, I tend to have my biggest losses. How can a trader retain a healthy level of anxiety while remaining confident enough to stay big? First, you have to know yourself. This isn't a small step. Most people are not willing to go inside themselves and explore because they are afraid of what they might find. Instead, they just say, I already know myself. But what if you have unlimited potential and don't know how to tap into it because you are not willing to explore how you are blocking yourself? Once you know yourself, you can set up objectives that you are comfortable with and a trading system that really fits you. That's part of having the confidence to trade your system. Let me ask you some questions, all of which are necessary to have a system that fits you. Have you written down your beliefs about the big picture? And does your trading system fit the big picture? Have you written down your beliefs about the market? What works and what doesn't? And does your system fit that? Have you written down your beliefs about each part of a trading system? And does your system fit that? Is your system mechanical, or is it a rule-based discretionary system? If it's neither, then you can never correct mistakes. Are your objectives clear, and do you have a position sizing algorithm that's designed to meet your objectives? When you perform all these steps, your trading will flourish. Do you know what types of markets your system will work in and when it will fail? Typically, if your trading system fits all those criteria, you'll feel really confident trading it. If it does not, here are more questions for you to answer. What are your criteria for feeling confident about a trading system? Do you understand how your system will perform in the 6 kinds of markets? I'll address this later. Here I don't mean just its average performance, but the statistical outliers. That is, 2 standard deviations away from the mean. Are you happy with that? Also, if your system is performing well above average, do you realize that and understand that below average performance usually will follow? Have you collected enough data to know your system's R-multiple distribution? Have you simulated trading that distribution so that you will know what to expect? Can you live with the results of that simulation, knowing the performance you are likely to get if your R-multiple distribution is accurate? Do you have a worst-case contingency plan? Do you know how to keep most of those potential disasters from wiping you out? This is an important part of confidence. If you are not there, you shouldn't be trading. Last, do you have a daily procedure to keep you on track? These procedures are designed to 1. Keep you disciplined, and, more important, 2. Prevent mistakes, or at least prevent you from repeating mistakes. One such procedure is discussed in the last part of this book. Trading is really a business. Most businesses fail because of lack of planning. Treat trading like a business, not a hobby. If you haven't done these things, you'll typically be the most confident at the end of a winning streak, and then have your biggest losses, just as you said. If you have done these things, you'll understand the big picture for you, and your performance will be much more consistent and elevated. I've seen major trading entities that did not cover many of these points with their traders. Most of them performed poorly or eventually failed. Also, I've coached some entities as well as many individuals, to encompass these points, and when they do that, they tend to flourish. What about you? End of part 3. Part 4. Understanding the importance of position sizing strategies. System quality numbers and position sizing strategies. In brief, your trading system employs a set of rules that tells you when and how to trade. The purpose of a trading system is to make sure that you can achieve your objectives easily through an effective position sizing strategy. Your position sizing strategy helps you determine how much equity to risk on every trade. Its purpose is to help you meet your objectives. You could have the world's best system, for example, one that makes money 95% of the time, and in which the average winner is twice the size of the average loser. And you still could go bankrupt if you risked 100% on one of the losing trades. A position sizing strategy helps you determine how much equity to risk given several inputs: the trading system's R-multiple distribution, your risk tolerance, the kind of returns you want to make, and your definition of ruin, whether that's bankruptcy or some level of drawdown. With a poor trading system, you may be able to meet your objectives, but you are setting yourself up for a hard and potentially frustrating job. However, if you create a holy grail system, you'll find it easy to meet even extreme objectives through an effective position sizing strategy. How would you know if you have a trading system that easily allows you to reach your objectives through position sizing strategies? There are several ways you could measure this performance, but I'll focus on a relatively simple method I believe is effective. Your trading system generates trades that have a distribution of R multiples. What is the relationship of the average of your trade results to the consistency of those results? Scientists and engineers regularly measure the ratio of the signal, that is, music, to noise, that is, static. For our purposes, the trading system signal is the expectancy, and the noise is the standard deviation of the R multiples. If you look at the ratio of the expectancy to the standard deviation of the R multiples, you generally can tell how easy it will be to meet your objectives by using position sizing strategies. Table 4:1 provides a rough guideline. It's relatively easy to use standard spreadsheet functions and calculate this ratio for your system trade results. I suggest analyzing your results once you have, at the very least, 30 R multiples, and preferably 50 to 100 R multiples. In addition to the expectancy and variability of a trading system's results, there is one other important variable in your system: the number of trades it generates. A system with a ratio of 0.75 doesn't really qualify as a holy grail system if it doesn't give you enough opportunities. However, if that same system trades 20 times a month, then you truly have a holy grail system. It gives you many opportunities to make money. After a number of years researching position sizing strategies, I've developed a proprietary measure of system performance that we call the system quality number, squadron. The squadron takes into account several variables. The specific calculation is beyond the scope of this book, although I do cover it extensively in my book, The Definitive Guide to Position Sizing. Regardless, let me share a few important observations I have found as a result of my research. It's very difficult to create a trading system with a ratio of mean R to standard deviation of R as high as 0.7. For example, if I take a system with a ratio of 0.4 and add a 30R winner, that single winner actually decreases the ratio, because it increases the standard deviation of R more than it increases the mean. For results worthy of Holy Grail status, your system needs a huge number of winners, and a small variation in the amounts won and lost. It is possible to develop a Holy Grail trading system if you restrict it to one specific type of market. Keep in mind, though, that such a system is in the Holy Grail range only for that particular market type. For example, quiet bull. You need to understand how your system works in various market types and use it only in the types of markets for which it was designed. This says a lot about developing systems, and it echoes what I said earlier. The common mistake most people make is to try to create or find a trading system that will work all the time. It's insane to think that any one system will work well in all market conditions. Buy and hold worked great in the late 1990s and horribly in the early 2000s. Instead, develop multiple trading systems that are close to the Holy Grail level for each market type. As testimony to the potential of what position sizing strategies can do for your trading results, I received a report from someone a while back. He was trading currencies from July 28th through October 12th, 2008, when most people were losing huge amounts of money. According to his calculations, the ratio between the expectancy of his system and its standard deviation was 1.5. That's double the ratio of what I call a holy grail system. Once he realized how good his system was, he started to risk position sizes at levels that are acceptable only with a holy grail system. Table 4-2 shows the unaudited results he reported to me. I've seen people make 1,000% per year before, but never anything quite like this. However, I'm willing to believe it is possible if he found a system that provided a ratio of an expectancy of R to a standard deviation of R of 1.53, as he indicated by the data he sent me. His stellar return was possible only after he realized that he had a holy grail trading system and that he could utilize a position sizing strategy to take advantage of it. As a result, he was able to increase his exposure per trade to a huge level that would bankrupt most traders using trading systems with lower ratios. Again, I have no verification that the information sent to me was true. I don't audit trading accounts. My business is coaching traders. This trader, however, sent his email to me as a thank you note for the insights he got from my advice. Given my understanding of trading systems and position sizing strategies, I'm willing to believe the results are possible. Position sizing strategies are more important than you think. Most people think that the secret to great investing is to find great companies and hold on for a long time. The model investor for this, of course, is Warren Buffett. The model that mutual funds work on is buying and holding great investments, and the goal is simply to outperform some market index. If the market is down 40% and they are down only 39%, they have done well. If you pay attention to the academic world, you'll learn that the most important topic for investors is asset allocation. There was a research study by Gary Brinson and his colleagues in the Financial Analyst Journal in 1991 in which they reviewed the performance of 82 portfolio managers over a 10-year period. They found that 91% of the performance variability of the managers was determined by asset allocation, which they defined as how much the managers had in stocks, bonds, and cash. It wasn't entry or what stocks they owned. It was this mysterious variable that they called asset allocation, which was defined in terms of how much. I recently looked at a book on asset allocation by David Darst, Chief Investment Strategist for Morgan Stanley's Global Wealth Management Group. On the back cover, there was a quote from Jim Cramer of CNBC. Leave it to David Darst to use plain English so we can understand asset allocation, the single most important aspect of successful performance. Thus, you'd think the book would say a lot about position sizing strategies, wouldn't you? When I looked at the book, I asked myself these questions. Does he define asset allocation as position sizing strategies? Does he explain or even understand why asset allocation is so important? Is position sizing how much even referenced in the book? I discovered that there was no definition of asset allocation in the book, nor was there any explanation related to the issue of how much or why asset allocation is so important. Topics such as position sizing strategies, how much, and money management were not even referenced in the book. Instead, the book was a discussion of the various asset classes one could invest in, the potential returns and risks of each asset class, and the variables that could alter those factors. To me, it proved that many top professionals don't understand the most important, non-psychological component of investment success, position sizing methods. I don't mean to pick on one book here, because I can make the same comment about every book on the topic of asset allocation I've ever looked through. Right now, most of the retirement funds in the world are tied up in mutual funds. Those funds are required to be 95% to 100% invested, even during horrendous down markets, such as the ones in 2000 to 2002 and 2008 to 2009. Those fund managers believe that the secret to success is asset allocation, without considering that the real secret is the how much aspect of asset allocation. This is why I expect that most mutual funds will cease to exist by the end of the secular bear market, when P/E ratios of the S&P 500 are well into the single-digit range. Banks, which trade trillions of dollars of foreign currency on a regular basis, don't understand risk at all. Their traders cannot practice position sizing strategies because they don't know how much money they are trading. They are trading the bank's money, not a segregated account. Most of them don't even know how much money they could lose before they lost their jobs. Banks make money as market makers in foreign currencies, and they lose money because they allow or even expect their traders to also trade these markets. They usually expect their traders to trade each day, even when there is no good trade to make. Rogue traders have cost banks about $1 billion each year over the last 2 decades. Yet I doubt that they could exist if each trader had his or her own account. I was surprised to hear Alan Greenspan say once that his biggest mistake as Federal Reserve Chairman was to assume that big banks would police themselves in terms of risk. They don't understand risk and position sizing strategies, yet now they are all getting huge bailouts from the government. By now, you are probably wondering how I know for sure that position sizing strategies are so important. Let me present a simple trading system. 20% of the trades are 10R winners, and the rest of the trades are losers. Among the losing trades, 70% are 1R losers, and the remaining 10% are 5R losers. Is this a good system? If you want a lot of winners, it certainly isn't that good because it has only 20% winners. But if you look at the average R for the system, it is 0.8R. That means that on average you'd make 0.8R per trade over many trades. Thus, when it's phrased in terms of expectancy, it's a winning system. Remember that this distribution represents the R multiples of a trading system with an expectancy of 0.8 R. It's not the market, it's the R multiples of a trading system. Let's say you made 80 trades with this system in a year. On average, you'd end up making 64 R, which is excellent. If you allowed R to represent 1% of your equity, which is one position sizing method, you'd be up about 64% at the end of the year. As was described earlier in this book, I frequently play a marble game in my workshops with this R multiple distribution to teach people about trading. The R multiple distribution is represented by marbles in a bag. The marbles are drawn out one at a time and replaced. The audience is given $100,000 to play with, and they all get the same trades. Let's say we do 30 trades, and they come out as shown in table 4-3. The bottom row is the total R multiple distribution after each 10 trades. After the first 10, we were up plus 8R. And then we had 12 losers in a row, and we're down 14R after the next 10 trades. Finally, we had a good run on the last 10 trades, with 4 winners, getting 30R for those 10 trades. Over the 30 trades, we were up 24R. That number divided by 30 trades gives us a sample expectancy of 0.8R. Our sample expectancy was the same as the expectancy of the marble bag. That doesn't happen often, but it does happen. About half the samples are above the expectancy and another half are below the expectancy, as illustrated in figure 4:1. The figure represents 10,000 samples of 30 trades drawn randomly, with replacement, from our sample R multiple distribution. Note that both the expectancy, defined by the average, and the median expectancy are 0.8 R. Let's say you are playing the game, and your only job is to decide how much to risk on each trade, or how to position size the game. How much money do you think you'd make or lose? Well, in a typical game like this, in which you win by having the most money at the end of the game, a third of the audience will go bankrupt. That is, they won't survive the first 5 losers or the streak of 12 losses in a row. Another third will lose money, and the last third typically will make a huge amount of money, sometimes over $1 million. In an audience of approximately 100 people, except for the 33 or so who are at zero, there probably will be 67 different equity levels. That shows the power of position sizing strategies. Everyone in the audience got the same trades, those shown in the table. Thus, the only variable was how much they risked. That is, their position sizing method. Through that one variable, we'll typically have final equities that range from 0 to over $1 million. That's how important a position sizing method is. I've played this game hundreds of times, getting similar results each time. Generally, unless there are a lot of bankruptcies, I get as many different equities at the end of the game as there are people in the room. Yet everyone gets the same trades. Remember the academic study that said that 91% of the performance variation of 82 retirement portfolios was due to position sizing strategies? Our results with the game show the same results. Everyone gets the same trades, and the only variable, besides psychology, is how much the players elect to risk on each trade. If the topic is ever accepted by academia or mainstream finance, it probably will change both of those fields forever. It is that significant. The 3 components of a position sizing strategy. Performance variability produced by a position sizing strategy has 3 components. See figure 4.2. They are all intertwined, and so it is very difficult to separate them. The first component is the trader's objectives. For example, someone who thinks, "I'm not going to embarrass myself by going bankrupt," will get far different results from those of someone who wants to win no matter the potential costs. In fact, I've played marble games in which I've divided the audience into 3 groups, each with a different objective and a different reward structure to make sure they have that objective. Although there is clearly sizable variability in within-group ending equities, there is also a distinct, statistically significant difference between the groups with different objectives. The second component, which clearly influences the first component, is a person's psychology. What beliefs are operating to create that person's reality? What emotions come up? What is the person's mental state? A person whose primary thought is not to embarrass herself by going bankrupt, for example, isn't going to go bankrupt even if her group is given incentives to do so. Furthermore, a person with no objectives and no position sizing guidelines will position size totally by emotions. The third component is the specific position sizing method, whether it is intuitive or a particular algorithm. Each model has many possible varieties, including the method of calculating the equity, which we'll discuss later. The CPR model for position sizing strategies. A simple model for determining how much involves risking a percentage of your equity on every trade. We've alluded to the importance of this decision throughout this book, but how exactly do you do that? You need to know three distinct variables. 1. How much of your equity are you going to risk? This is your total risk, but we will call it cash, or C for short. Thus, we have the C in our CPR formula. For example, if you were going to risk 1% of your equity, C would be 1% of your equity. If you had a $50,000 account, C would be 1% of that, or $500. 2. How many units do we buy? That is, what is your position sizing method? I call this variable P for position sizing method. 3. How much are you going to risk per unit that you purchase? We will call this variable R, which stands for risk. We've already talked about R in our discussion of expectancy. For example, if you are going to buy a $50 stock and risk $5 per share, your risk, R, is $5 per share. Essentially, you can use the following formula to determine how much to buy. P equals C divided by R. Let's look at some examples so that you can understand how easy it is to apply this formula. Example 1. You buy a $50 stock with a risk of $5 per share. You want to risk 2% of your $30,000 portfolio. How many shares should you buy? Answer: R equals $5 divided by share. C equals 2% of $30,000 or $600. P equals 600 divided by 5 equals 120 shares. Thus, you would buy 120 shares of a $50 stock. Those shares would cost you $6,000, but your total risk would be only 10% of your cost, that is, assuming you kept your $5 stop, or $600. Example 2. You are day trading a $30 stock and enter into a position with a 30-cent stop. You want to risk only 0.5% of your $40,000 portfolio. How many shares should you buy? Answer: R equals 30 cents divided by share. C equals 0.005 times $40,000, or $200. P equals 200 divided by 0.3 equals 666.67 shares. Thus, you'd buy 666 shares that cost you $30 each. Your total investment would be $19,980, or nearly 2/3 of the value of your portfolio. However, your total risk would be only 30 cents per share, or $199.80, assuming you kept your 30-cent stop. Example 3. You are trading soybeans with a stop of 20 cents. You are willing to risk $500 in this trade. What is your position size? A soybean contract is 5,000 bushels. Say soybeans are trading at $6.50. What size position should you put on? Answer: R equals 20 cents times 5,000 bushels per contract equals $1,000. C equals $500. P equals $500 per $1,000, which is equal to 0.5. However, you cannot buy a half contact of soybeans. Thus, you would not be able to take this position. This was a trick question, but you need to know when your position has way too much risk. Example 4. You are trading a dollar Swiss franc forex trade. The Swiss franc is at 1.4627, and you want to put in a stop at 1.4549. That means that if the bid reaches that level, you'll have a market order and be stopped out. You have $200,000 on deposit with the bank and are willing to risk 2%. How many contracts can you buy? Answer: your R value is 0.0078, but a regular Forex contract would be trading at $100,000, and so your stop would cost you $780. Your cash at risk, C, would be 2% of $200,000, or $4,000. Thus, your position size would be $4,000 divided by $780, or 5.128 contracts. You round down to the nearest whole contract level and purchase 5 contracts. Position sizing basics. Until you know your system very well, I recommend that you risk a maximum of 1% of your equity on any one position. This means that 1R is converted to a position size that equals 1% of your equity. For example, if you have $100,000, you should risk $1,000 per trade. If the risk per share on trade 1 is $5, you'll buy 200 shares. If the risk per share on trade 2 is $25, you'll buy only 40 shares. Thus, the total risk of each position is now 1% of your account. Let's see how that translates into successive trades in an account. On your first trade with equity of $100,000, you would risk $1,000. Since it is a loser, as shown in Table 4.4, you'd now risk 1% of the balance, or $990. It's also a loser, and so you'd risk about 1% of what's left, or $980. Thus, you'd always be risking about 1% of your equity. Table 4.4 shows how that would work out with the sample of trades presented in Table 4.3. Remember that in this sample of trades you were up 24R at the end of the game. This suggests that you could be up about 24% at the end of the game. We're up 22.99%, so we almost made it. Equity peaks are shown in bold, and equity lows are shown in italics. Because of the drawdowns that came early, you would survive. You have a low equity of about $91,130.99 after the long losing streak, but you are still in the game. At the end, you would be up about 23%. Even though you risked 1% per trade, and were up 24R at the end of the game, that doesn't mean you'd actually be up 24% at the end of the game. That would occur only if you'd risked 1% of your starting equity on each trade, which is a different position sizing algorithm. You wouldn't win the game with this strategy because someone who does something incredibly risky, such as risking it all on the 6th trade, usually wins the game. The important point is that you'd survive, and your drawdown wouldn't be excessive. Types of equity models. All the models you'll learn about in this book relate to the amount of equity in your account. These models suddenly can become much more complicated when you realize that there are 3 methods of determining equity. Each method can have a different impact on your exposure in the market and your returns. These methods include the core equity method, the total equity method, and the reduced total equity method. The core equity method is simple. When you open a new position, you simply determine how much you would allocate to that position in accordance with your position sizing method. Thus, if you had 4 open positions, your core equity would be your starting equity minus the amount allocated for each of the open positions. Let's assume you start with an account of $50,000 and allocate 10% per trade. You open a position with a $5,000 position sizing allocation using one of the methods described in the following section. Different position sizing models. You now have a core equity of $45,000. You open another position with a $4,500 position sizing allocation. Now you have a core equity of $40,500. You open a third position with an allocation of $4,050, and your new core equity is $36,450. Thus, you have a core equity position of $36,450 plus 3 open positions. In other words, the core equity method subtracts the initial allocation of each position and then makes adjustments when you close that position out. New positions always are allocated as a function of your current core equity. If your method of allocation is percent risk, then the risk amount would be your allocation. Thus, if you bought 100 shares of a $100 stock with a stop at $95, your risk allocation would be $500. The total amount invested would be $10,000. But your allocation would just be the risk amount, not the total amount invested. I first learned about the term core equity from a trader who was famous for his use of the market's money. This trader would risk a minimum amount of his own money when he first started trading. However, when he had profits, he'd call that market's money, and he would be willing to risk a much larger proportion of his profits. This trader always used a core equity method in his position sizing algorithm. The total equity method is also very simple. The value of your account equity is determined by the amount of cash in your account, plus the value of any open positions. For example, Suppose you have $40,000 in cash plus one open position with a value of $15,000, one open position worth $7,000, and a third open position that has a value of $2,000. Your total equity is the sum of the value of your cash plus the value all your open positions. Thus, your total equity is $62,000. Tom Basso, who taught me methods for maintaining a constant risk and a constant volatility, always used the total equity model. It makes sense if you want to keep your risk constant. You want to keep the risk a constant percentage of your total portfolio value. The reduced total equity method is a combination of the first two methods. It is like the core equity method in that the exposure allocated when you open a position is subtracted from the starting equity. However, it is different in that you also add back in any profit or reduced risk that you will receive when you move a stop in your favor. Thus, reduced total equity is equivalent to your core equity plus the profit of any open positions that are locked in with a stop, or the reduction in risk that occurs when you raise your stop. Here's an example of reduced total equity. Suppose you have a $50,000 investment account. You open a position with a $5,000 position sizing allocation. Thus, your core equity and reduced total equity is now $45,000. Now suppose the underlying position moves up in value, and you have a trailing stop. Soon you have only $3,000 in risk because of your new stop. As a result, your reduced total equity today is $50,000 minus your new risk exposure of $3,000, or $47,000. The next day, the value drops by $1,000. Your reduced total equity is still $47,000, since the risk to which you are exposed if you get stopped out is still $47,000. It changes only when your stop changes to reduce your risk, lock in more profit, or close out a position. The models briefly listed in the next section generally size positions in accordance with your equity. Thus, each model of calculating equity will lead to different position sizing calculations with each model. Different position sizing models. In most of my books, I talk about the percent risk position sizing model. It's easy to use, and most people can be safe trading at 1% risk. However, in the definitive guide to position sizing, 7, I list numerous position sizing methods, all of which can be used to achieve your objectives. My goal here is to list a few of the methods so that you can see how extensive your thinking about position sizing strategies can be. In the percent risk model, which we have described as CPR for traders and investors, you simply allocate your risk to be a percentage of your equity, depending on how you want to measure it. In some of the other methods, you use a different way to allocate how much to trade. Here are some examples of ways you could allocate assets as a position sizing method. 1. Units per fixed amount of money, buying 100 shares per $10,000 of equity, or 1 contract per $10,000. 2. Equal units/equal leverage, buying $100,000 worth of product, shares or values of the contract per unit. 3. Percent margin, using a percent of equity based on the margin on a contract rather than the risk. 4. Percent volatility, using a percent of equity based on the volatility of the underlying asset rather than the risk as determined by R. 5. Group risk, limiting the total risk per asset class. 6. Portfolio heat, limiting the total exposure of the portfolio, regardless of the individual risk. 7. Long versus short positions, allowing long and short positions to offset in terms of the allocated risk. 8. Equity crossover model, allocating only when the equity crosses over some threshold. 9. Asset allocation, when investing in only one class of asset, investing a certain percentage of one's assets, say 10%, in some asset class. 10. Over and underweighting one's benchmark, buying the benchmark and considering an asset as being long when you overweight it and short when you underweight it. 11. Fixed ratio position sizing, a complex form of position sizing developed by Ryan Jones, requires a lengthy explanation. 12. Two-tier position sizing, risking 1% until one's equity reaches a certain level, and then risking another percentage at the second level. 13. Multiple tier approach, having more than 2 tiers. 14. Scaling out of a position when certain criteria are met. 15. Scaling in, adding to a position based on certain criteria. 16. Optimal F, a position sizing method designed to maximize gains and drawdowns. 17. Kelly criterion, another form of position sizing maximization, but used only when one has two probabilities. 18. Basso-Schwager asset allocation, periodic reallocation to a set of non-correlated advisors. 19. Markets money techniques, thousands of variations, risking a certain percentage of one's starting equity and a different percentage of one's profits. 20. Using maximum drawdown to determine position sizing algorithm, not exceeding a certain drawdown that would be too dangerous for your account. Are you beginning to understand why position sizing strategies are much more important and much more complex than you have conceived of in your trading plans to date? There are many more models in the definitive guide to position sizing, and some of the models have an infinite number of varieties that could be modified to meet your objectives. The purpose of position sizing strategies. Remember that a position sizing strategy is the part of your trading system that helps you meet your objectives. Everyone probably has different trading objectives, and there are probably an infinite number of ways to approach position sizing methods. Even the few people who have written about position sizing strategies get this point wrong. They typically say that position sizing strategies are designed to help you make as much money as you can without experiencing ruin. Actually, they are giving you a general statement about their own objectives and beliefs about position sizing strategies. Let's play our game again with the 0.8R expectancy. Say I give the following instructions to the people playing the game. 100 people are playing. First, it costs $2 to play the game. Second, if after 30 trades your account is down from $100,000 to $50,000, it will cost you another $5. Third, if you go bankrupt, you will have to pay another $13, for a total loss of $20. If at the end of 30 trades you have the most equity, you will win $200. Furthermore, the top 5 equities at the end of the game will split the amount of money collected from those who lose money. Your job is to strategize about how you want to play the game. I recommend that you use the following procedure. It is also an excellent procedure to follow in real-life trading to develop a position sizing strategy to fit your objectives. First, decide who you are. Possible answers might be: 1. Someone who is determined to win the game. 2. Someone who wants to learn as much as possible from playing the game. 3. A speculator. Or 4. A very conservative person who doesn't want to lose money. The next step is to decide on your objectives. In light of the various payoff scenarios, here are possible objectives. 1. Win the game at all costs, including going bankrupt. The person winning the game usually has this as the objective. 2. Try to win the game but make sure I don't lose more than $2. 3. Try to win the game but make sure I don't lose more than $7. 4. Win the game but don't go bankrupt. 5. Be in the top 5 and don't lose more than $7. 6. Be in the top 5 and don't lose more than $2. 7. Be in the top 5 at all costs. 8. Do as well as I can without losing $7. 9. Do as well as I can without losing $2. 10. Do as well as I can without going bankrupt. Note that even the few rules I gave for payoffs translate into 10 different objectives that you could have. Creative people might come up with even more. You then need to develop a position sizing strategy to meet your objectives. The last step is to decide when to change the rules. At the end of every 10 trades, I assess the room to determine who has the highest equity. If at the end of 10 trades you are not on track to reach your objectives, then you might want to change your strategy. Notice how this changes what could happen in the game. Chances are that I'll still have as many as 100 distinct equities, but chances are also that there will be a strong correlation between the objectives people select and their final equity. Those who want to win the game probably will have huge equity swings, ranging from $1 million or more to bankruptcy. However, those who want to do as well as they can without going bankrupt probably will trade quite conservatively and have their final equities distributed within a narrow range. The game makes it clear that the purpose of position sizing strategies is to meet your objectives. As I said earlier, few people understand this concept. One way to use position sizing strategies to meet your objectives. Simulation. One way to use position sizing strategies to meet your objectives is to use a simulator. We will assume that there is only one position sizing method: the percentage of your equity you are willing to risk per trade. Here is how we can set up a trading simulator by using the system that was described earlier. Its expectancy is 0.8 R, and it has only 20% winners. We know the expectancy will allow us to make 40 R over 50 trades on the average. Our objective is to make 100% over 50 trades without having a drawdown of more than 35%. Let's see how we can do that with an R multiple simulator. I've set up a simulation model to run 10,000 simulations of 50 trades for our system. It will risk 0.1% for 50 trades 10,000 times, then it will move up to 0.2%, then to 0.3%, and so on in 0.1% increments until it reaches 19% risk per trade. We have a 5R loss, and so a 20% risk automatically results in bankruptcy when that is hit. Thus, we are stopping at a 19% risk per position. The simulation model will run 10,000 50-trade simulations at each risk level unless it reaches our criteria of ruin, that is, down 35%, in which case it will say that it has reached the ruin point and move on to the next one in the sequence of 10,000 simulations. That's a lot of computing to be done, but today's computers can handle it easily. The results of this simulation are shown Table 4.5. The top row gives the risk percentage that delivers the highest mean ending equity. Typically, this is the largest risk amount simulated because there will be a few samples that may have many 10R winners. That run would produce a huge number and boost the average result, even if most runs resulted in a drop of 35% or more. Note that at 19% risk, the average gain is 1,070%. However, we have only a 1% chance of making 100% and a 98.7% chance of ruin. This is why going for the highest possible returns, as some people suggest, is suicidal, with a system that is at best average. The median ending equity is probably a better goal. This gives an average gain of 175% and a median gain of 80.3%. You have a 46.3% chance of meeting your goal and a 27.5% chance of ruin. What if your objective is to have the largest percent chance of reaching the goal of making 100%? This is shown in the optimum retiree row. It says that if we risk 2.9%, we have a 46.6% chance of reaching our goal. However, our median gain actually drops to 77.9% because we now have a 31% chance of ruin. What if our objective is just under a 1% chance of ruin, being down 35%? The simulator now suggests that we should risk 0.9% per trade. This gives us a 10.5% chance of reaching our goal, but only a 0.8% chance of ruin. You could have your objective be just above a 0% chance of ruin. Here the simulator says you could risk 0.6%. The risk is just above 0%, but the probability of reaching your objective of making 100% is now down to 1.7%. Finally, you might want to use the risk percentage that gives you the largest probability difference between making 100% and not losing 35%. That turns out to be risking 1.7%. Here we have a 37.9% chance of reaching our objective and only an 11.1% chance of ruin. That's a difference of 26.8%. At the other risk levels given, it was 15% or less. Just by using two different numbers, a goal of 100% and a ruin level of 35%, I came up with 5 legitimate position sizing strategies that just used a percent risk position sizing model. I could set the goal to be anything from up 1% to up 1,000% or more. I could set the ruin level from anything from being down 1% to being down 100%. How many different objectives could you have? The answer is probably as many as there are traders/investors. How many different position sizing strategies might there be to meet those objectives? The answer is a huge number. We used only one position sizing strategy, percent risk. There are many different position sizing models and many different varieties of each model. The problems of the R multiple simulator. Obviously, there are some huge advantages to simulating your system's R multiple distribution to help you learn about that system easily. However, there are also some serious problems with R multiples. Unfortunately, nothing in the trading world is perfect. The problems, in my opinion, are as follows. R multiples measure performance on the basis of single trades, but won't tell you what to expect when you have multiple trades on simultaneously. R multiples do not capture many of the temporal dependencies, correlations, among the markets. In fact, only the start date and stop date of a trade are extracted. Thus, you cannot see drawdowns that occur while a trade is still on, and you are not stopped out, that is, by 1R. As with all simulations, R-multiple simulations are only as good as your sample distribution is accurate. You may have a good sample of your system's performance, but you never will have the true population. You probably have seen your worst loss or your best gain. R-multiples are a superb way to compare systems when the initial risk is similar. However, they present some problems when one or more of the systems have a position sizing method built into the strategy, such as scale-in and scale-out models. In fact, in these conditions, you would have trouble determining the absolute performance of two different systems. As an example, compare two systems. System 1 opens the whole position at the initial entry point. System 2 opens only half the position at the initial entry point, and the other half after the market moves in favor of the system by 1 volatility. If we get an excellent trade, say a 20R move, the R multiple of System 1 will be bigger than that of System 2, larger profit and smaller total initial risk. However, if we get a bad trade that goes immediately against us and hits the initial exit stop, the R multiple is the same for both systems, namely, -1. The fact that System 2 loses only half of the money System 1 loses is completely missed. The impact of position sizing techniques, like pyramids, that change the total initial risk of a trade, are difficult to test with the concept of R multiples because the R multiple distributions of the trading systems, with and without the position sizing technique, cannot be compared directly. One way to evaluate the money management technique is to divide the trading system into subsystems so that the subsystems are defined by the entry points and evaluate each subsystem separately. For instance, each pyramid could be treated as a subsystem. Since R multiples capture only a few of the temporal dependencies between markets, simulations using R multiples must be based on the assumption that the R multiples are statistically independent, which is not the case in reality. However, one can cluster trades according to their start date or stop date, and thus try to introduce a time aspect into simulations. When you do this, the volatility and the drawdowns become considerably larger when the R multiples are blocked. In other words, simulations based on one trade at a time clearly produce results that are too optimistic. 1. When you are trying to determine the performance of systems that generate multiple trades at the same time, and 2. When you are trading multiple systems simultaneously. People have asked about obtaining a trading system simulation tool, but we've elected not to make one available. All the problems listed above might not be known to or considered fully by someone who might use it. Getting around the problems of simulation. To get around the problems with a simulator, I developed the system quality number, squadron. Generally, the higher the squadron, the more liberties you can take with position sizing strategies to meet your objectives. In other words, the higher the squadron is, the easier it is to meet your objectives. For example, I commented earlier on a trader who claimed to have a 1.5 ratio between the expectancy and the standard deviation of R in a currency trading system that generated nearly one trade each day. Although I don't know if it is possible to develop such an incredible system, if he does have one, I have no doubt about his results. Turning $1,300 into $2 million in a little over 4 months during a period when most of the world was having a terrible economic crisis. In the definitive guide to position sizing, I was able to show how, with 31 different position sizing models, 93 total since each can use any of the 3 equity models, it was possible to achieve your objectives easily from the squadron. Nevertheless, there are still precautions you must take because of the following. 1. You never know if your R multiple distribution is accurate. 2. You never know exactly when the market type will change, which usually changes the squadron. 3. You have to account for multiple correlated trades. I did this with the squadron by assuming that the maximum risk was for the entire portfolio rather than for a single position. Thus, in our example, with an average at best system and a ratio of the mean to the standard deviation of about 0.16, our best risk percentage was 1.7%. However, if we were to trade 5 positions at the same time, our risk per position probably would have to be reduced to about 0.35%. However, a Holy Grail system might allow us to risk 5% or more per position. End of Part 4. Part 5. Reducing mistakes and using other ways to make more consistent profits. Mistake-free trading. As I've mentioned, we have a limited capacity for processing information. In fact, consciously we can hold 7 plus or minus 2 chunks of information. That number is reduced dramatically under stress. When blood flow is diverted from the brain to the major muscles of the body, to deal with approaching danger. In today's world, the danger is usually mental, and being able to run faster or perform feats of strength doesn't help us deal with trading dangers. Every year, the total amount of information we have to deal with as traders doubles, but our capacity stays the same. As a result, we've developed a number of shortcuts, that is, heuristics, to process information. In fact, psychologists have been documenting many of them over the years, and have been calling them judgmental heuristics. The overall conclusion is that human beings are very inefficient at processing information. In fact, some economists have begun to move away from the efficient market camp into the idea that markets are inefficient. They are inefficient because humans are inefficient decision makers. Their conclusion is excellent, but what they've done with it is not. What's happened is that a new school of economics behavioral finance has sprung up. Now economists are asking, if markets are not efficient because humans are inefficient, how can we use what we now know about human inefficiencies to predict what the markets will do? In my opinion, this is lunacy. You might call what I do with traders applied behavioral finance, and I take a different approach. I say that if most human beings are inefficient in the way they process information, what would happen if you made them efficient? Let's say a human being is 5% efficient in dealing with market information, although this is probably a high estimate for most people. What would happen if I could make a person 25% efficient? What would happen if I could make that person 50% efficient, or even 100% efficient? The results might surprise you. I previously talked about how trading systems may be considered a distribution of R multiples, with a mean, that is, expectancy, and standard deviation that characterize the distribution. Let's look at what inefficiency might do to the trading results from that distribution. Let's return to our system that gives you an expectancy of 0.8 R and generates 100 trades each year. That system is not unrealistic. In fact, our sample system was barely a tradable system. I've seen much better systems. Yet that system, on average, will generate a return of 80 R per year. If you were to risk 1% per trade, you probably could make 100% per year trading it. That is, 1% gets bigger as your equity grows, which is why you could make 100% instead of 80%. However, because of behavioral inefficiencies, most people will make lots of mistakes, where a mistake means that documented trading rules were broken. What's a mistake worth? I don't know for sure. We need to collect a lot of data to figure that out, and it'll be different for everyone. However, for now, let's say a mistake is worth on average 4 R. If that's the case and you made a mistake on every other trade, that is, 40 mistakes per year, then you'd have 160 R worth of mistakes. You'd lose money trading a system that potentially could give you 100%. In contrast, let's say you make only one mistake a month. Most profitable traders probably do that. If you make a mistake a month, that's 48 R lost out of 80 R, leaving you 32 R in profits. During a severe drawdown in the system, you might give up on the system, thinking it no longer works. Our system generates about 7 to 8 trades per month, and so we could say that this trader makes one mistake per 8 trades in executing the system. In other words, she's 87.5% efficient in terms of mistake-free trades. However, in terms of profits, she's made only 32 Rs out of a potential 80 R. Thus, in terms of profits, she's only 40% efficient. What would happen if she could become 60% efficient in terms of profits, or 80% or more? The increase in return would be phenomenal. Perhaps it's time to read about some of the common inefficiencies that human beings have and learn how to become more efficient as a trader. Follow the suggestions in this book and you'll become much more efficient. Mistakes and self-sabotage. A mistake occurs when you don't follow your written trading rules. If you develop a working business plan to guide your trading, you'll have numerous rules that you'll need to follow. If you don't develop such rules, everything you do will be a mistake. I've been asking the traders I coach to keep track of their mistakes in terms of R. For example, if you enter the market on emotion and make 2 R, that counts as plus 2 R toward that mistake. If you do it again and lose 4 R, you now have minus 2 R toward that mistake. If you do that for about a year, you'll have a good idea about how efficient you are as a trader and what your efficiency costs you. One of my clients was a futures trader who was running a $200 million account. We estimated that over one 9-month period he made 11 mistakes, costing him 46.5 R. He made 1.2 mistakes per month at a cost of 4.23 R per mistake. Overall, his profit was probably 50% less than it could have been because of mistakes. Thus, if he made 20%, he probably could have been up 70%. Can you begin to see the impact of such mistakes? Another client was a long-term position trader who primarily traded ETFs with wide stops. In a year of trading, he made 27 mistakes, costing him 8.2 R. Thus, over a year he made 2.25 mistakes per month. However, because he was trading long-term with large stops and no leverage, his mistakes were not as costly. Each mistake was costing him 0.3 R. During the year of trading, he was up 31 R and about 30%. If he had not made any mistakes, he would have been up 39.2 R. Thus, his mistakes cost him 20% of his profits. A third client was just starting to swing trade, and many of his errors were beginner types of mistakes. Over the course of his first year of trading, he broke even, but he made 28 mistakes during that year, costing him a total of 31 R. Had he traded at 100% efficiency, or even 95%, his first year would have been quite profitable. We might be able to guess that mistakes are worth 4 R to a futures trader, 1 R to an equity swing trader, and 0.3 R to a longer-term position trader. However, this is still just speculation. What are your mistakes costing you? Mechanical traders and mistakes. I've always said that trading is mostly psychological, and that traders should spend a lot of time working on their core issues. In fact, most of my super traders spend at least a year working on psychological issues before they get to work on their business plan or trading systems. One area where psychological issues can appear in trading is in mistakes. So let's look at the psychology of trading from the angle of mistakes. When you don't follow your rules, you make a mistake. It's that simple. And making the same mistake repeatedly is called self-sabotage. Self-sabotage is another area of psychology rich with the opportunity for understanding yourself to improve your trading results. Here, however, we'll focus on mistakes relating to some broad categories of traders. First, let me introduce one way to measure the impact of mistakes on your trading. Trader efficiency is a measure of how effective a trader is in making mistake-free trades. So a person who makes 5 mistakes in 100 trades is 95% efficient. In the last 5 years, I've requested that my super traders document their mistakes so that we can look at their efficiency levels. I have found that 95% is actually a very good trading efficiency level. Many traders can't even trade at 75% efficiency, which is terrible. That's 1 mistake in about every 4 trades. This is most important for one category of traders, rule-based discretionary traders. In my opinion, when rule-based discretionary traders become efficient, they are by far the best type of trader. There are 2 other groups of traders I'd like to talk about. 1. Mechanical traders, and 2. No-rules discretionary traders. First, we'll look at mechanical traders. Mechanical traders believe that they can eliminate psychologically related trading problems by becoming mechanical. Many people aspire to be mechanical traders, letting a computer make all the decisions for them because they believe it will factor out many human-based errors. In fact, one of my best trader friends said to me once that psychology didn't enter into his trading because his operation was totally automated. My response was, you could decide not to take a trade. About 18 years after I made that statement, his commodity trader advisor (CTA) business closed down. His partner decided against taking 1 trade, the trade that would have made their entire year had they taken it. I've always said that people can trade only their beliefs about the market, so let's look at some of the most important beliefs that a pure mechanical trader might have. With mechanical trading, I can be objective and not make mistakes, except the psychological mistake of overriding my system. Mechanical trading is objective. My system testing will allow me to determine my future results. Mechanical trading is accurate. If a system's underlying logic cannot be turned into a mechanical trading system, it probably isn't worth trading. Human judgment is too prone to errors. I can eliminate those through mechanical trading. So then, is mechanical trading truly objective? I tend to think not, because there are all sorts of errors that can creep into an automated trading system. Data errors, errors in the software platform, errors in your own programming, and many more. Interestingly, one of the main categories of errors that my super traders come up with consistently is programming errors. Let's consider data errors. Is your data accurate, or does it have bad ticks and other issues with it? Mechanical traders are always dealing with data errors of some sort. For example, price errors can show up in streaming data quite regularly. Sometimes those are resolved within seconds and the error disappears, but by that point, the bad data may have triggered a trade already. Additionally, historical stock data may or may not have dividend and split adjustments. And what happens when a company goes bankrupt? What if it goes private, or it is bought out by another company? Those companies' data may simply disappear from your dataset. I once wanted to research an efficient stock trading system. We looked for efficient stocks, moving up without much noise, and bought them with a 25% trailing stop. We had an S&P 500 dataset, going back 40 years, that was supposed to be clean and adjusted for splits and dividends. I was very pleased with the results because my system made a small fortune. I didn't realize this at the time, however, but the system traded on inside information. Because of the dataset, I was able to buy stocks at the IPO that would later become part of the S&P 500. Thus, my system, in backtest, bought Microsoft, eBay, Intel, and many other companies before anyone knew they would become part of the S&P 500. Why? Because, as I said, my dataset was today's S&P 500, going back 40 years. And what about Thursday, May 6, 2010? The Dow Jones dropped 1,000 points in the space of about 20 minutes. Blue-chip stocks like Procter & Gamble dropped over 20 points, and Accenture even went to a penny per share briefly. While there may not have been one root cause for that mini-crash, it had a major effect on mechanical trading systems. Things like that happen in the markets. Such are the challenges, errors, and/or mistakes for mechanical systems. That afternoon swing affected lots of regular traders too. One client said he used 25% trailing stops on all of his positions and got stopped out of every single stock. Meanwhile, one of our instructors, Ken Long, trades rule-based discretionary systems and made 100R in that same week. As always, he was very conservative in his trading and very careful to make sure that he fully managed his risk. There is another class of error that is made by mechanical trading systems. The error of omission, because the criteria by which trade setups and entries are so precisely defined. Mechanical systems miss many good or great trades that a discretionary trader would spot easily. For example, suppose your system screens for 5 consecutive lower closes. After you get 5 consecutive lower closes, you then look for an inside day. Now you have your full setup. Your entry is a few cents above yesterday's high. So let's look at some examples of other entry signals you might miss by being so precise. You could have 4 down days that were extreme. Perhaps the price is down 30%. Or you could have fewer than 4 down days where the price is 30% lower or more. However, neither of those examples would be an adequate down move according to your strict mechanical criteria. Let's say you found something that had 5 days of new lower lows, but the 5th down day opens on a new low and then closes on a new high. That's usually an extremely bullish signal, but you'd miss it by your precise definition. Or you could have 5 days of lower closes, and the 6th day opens on a new low but closes on a new high. Thus, the precise entry definition would miss a trade opportunity, with even more weakness, followed by an extreme bullish signal. There are a lot more variations of this entry that a mechanical system would miss, but you get the point. As soon as you state your rules so precisely that a computer can execute the trades, you open yourself to errors of omission, good or outstanding trades that your automated system cannot take because of its precision. Those missed opportunities don't qualify as mistakes, but they severely limit the potential results of the underlying logic behind the system. The mechanical system results will look rather weak next to the results of a trader who used that same system and was allowed some discretion to take all of those other trades that didn't quite fit the precise mechanical system rules. Many of my initial models of good traders were pure mechanical traders. Ed Seykota, Tom Basso, Chuck LeBeau. I'm 90% sure about the following, but I haven't modeled them. Bill Eckhart, Renaissance Capital Management, one of the best trading firms ever, and they computerize day trading systems through neural networks. Thus, I'm not saying don't be a mechanical trader, just realize the limitations of mechanical trading. Next, we'll look at mistakes and another type of trader, the no-rules discretionary trader. No-rules discretionary traders and mistakes. In my experience, when most people say, I am a discretionary trader, it basically means that they are free to do whatever they want. They can take a newsletter recommendation, trade a high probability setup based on what some guru said in a workshop last year, or perhaps just buy something on a whim. They might feel they have 20 different systems with none of them rigid. In reality, they have no systems at all. What they really have is a little bit of nothing, and a lot of intuition, as opposed to intuition. As a result of having no system and no rules, they have no way of effectively managing their trading. How well do you think a company would operate with no plans, no business systems, and no rules? Because they have no rules to follow. Everything no rules discretionary traders do is a mistake. Now, in fairness, some discretionary traders have rules for at least a portion of their trading. There's hope for these people because they have a starting point. Those who are totally no-rules discretionary traders, however, have no hope and should either stop trading or totally revamp their trading business. Are you a discretionary trader? How would you be able to tell? Here is a quiz that will help you decide. Answer yes or no to the following questions. 1. Do you sometimes buy newsletter recommendations without having a real plan for how you'll get out of the trade? 2. Do you occasionally, or often, take trades based upon some interesting indicator that you learned in a workshop? That is, when you see that indicator go, you usually get into a trade, but again, you have no real plan about how you'll get out of the trade. 3. Do you trade 3 or more different systems in the same account? 4. Do you trade more than 10 different systems? 5. Do you sometimes enter a trade and later not remember why? 6. Are you unsure of how many systems you have? 7. Do most of your systems lack a complete set of rules to guide your behavior? 8. Are your systems equivalent to the setups used to get into the trades and nothing more? 9. Are you unable to list the rules for the last trade you made? 10. Are you unable to list the rules for any of the last 5 trades you made? If you answered yes to as many as 2 of the questions above, you have some elements of a no-rules discretionary trader. However, if you answered yes to 6 or more questions above, you definitely are a no-rules discretionary trader. Chances are you seldom make money in the market because you are not playing a winning game. You probably make many mistakes. In fact, since you don't have rules, I would consider everything you do to be a mistake until you have a set of rules in place. How can you effectively learn from any of your trading experiences if you do not know which ones are mistakes? If it is any consolation, most traders fall into the no-rules discretionary category. The best among this group might be dedicated to following the trades of a single newsletter. If that applies to you, do you even know the rules of the newsletter? Does the newsletter writer have rules to guide his trading? Chances are, if he must come out with a specific recommendation once every month on a specific date, he doesn't have such rules. And chances are also good that you don't follow the recommendations of the newsletter writer exactly. You don't take some trades, you may miss some others, you buy at a price other than that recommended, and you probably don't sell when you are told to. Again, these are all signs of a no-rules discretionary trader. Next, we'll look at rule-based discretionary traders. Rule-based discretionary traders and mistakes. Chances are you've never heard of a rule-based discretionary trader. They are rare, but they are among the best traders in the world. I can safely say that anyone who graduates from my Super Trader program has either become a rule-based discretionary trader or a mechanical trader. Here are some rules that such a trader might have. Look at a small universe of stocks that behave well according to my rules. In other words, not every stock has to behave according to your rules. You just find stocks that do. Look for a strong overreaction to the downside. This would have a very specific description. For example, market closes down for 6 straight days. Look for move with a high probability, for a continuation in my favor. This might be one or several rules that are clearly specified. Have a likely target in mind based on a prior swing high, so that the difference between the entry price and the high is my likely target. Place a stop below the most recent low of the last down day, so that the difference between that low and the entry price is the risk of the trade. Look for a strong overreaction to the downside. This would have a very specific description. For example, market closes down for 6 straight days. Look for move with a high probability, for a continuation in my favor. This might be one or several rules that are clearly specified. Have a likely target in mind based on a prior swing high, so that the difference between the entry price and the high is my likely target. Place a stop below the most recent low of the last down day, so that the difference between that low and the entry price is the risk of the trade. Make sure that the reward-to-risk ratio of any trade is at least 3 to 1. If it's not, look for another trade. Raise the stop when the market makes a new level of support and rises to a new high. Make sure that the ongoing reward to risk in the trade is always above 1 to 1 to allow for profits bigger than 3 Rs. Never have more than 4 active positions at a time so that every trade can be carefully managed. Never risk more than 0.5% of equity per position. Never have more than 1% open risk in my account at any given time. Evaluate my mistakes each evening and work to make my trading efficiency 95% or better. Reevaluate my rules if I'm not up by at least 5R at the end of the month. Notice how every aspect of trading is covered by these rules. They allow for some discretion, that is, what constitutes a 3-to-1 reward to risk trade and the ability to stay in the trade after it reaches your target. But at the same time, there are clear guidelines for the trade. In addition, the trader could add a few other discretionary rules to improve his or her performance. I can re-enter the trade once if the reward to risk potential is still at least 3-to-1. I can add a second position to the trade the first time I raise my stop if the new reward to risk ratio is at least 5-to-1. If something really bothers me about the trade and I can document it, I don't take it. The rules I've given are just examples. I'm not even saying that they are profitable rules, although I've seen similar rule sets that are exceptionally good. What I am saying is that at the end of the day, this trader can do a daily debriefing and ask, did I make any mistakes? Did I follow my rules? He can 1. Record any mistakes, 2. Assess the impact of the mistakes in terms of R multiples, and 3. Take corrective steps to avoid those mistakes in the future. These tasks are critical to developing strong, consistent performance. Can you see how these steps are impossible for the no-rules discretionary trader? The list of superb rule-based discretionary traders that I know of is very long. Here are just a few of them. 1. Paul Tudor Jones, and probably all the traders that work for him, including several that I've consulted with. 2. Richard Dennis, and most turtles that I know of. 3. William O'Neill. 4. David Ryan. 5. Marty Schwartz. 6. Peter Steidlmayer. 7. Chuck Whitman, the president of Infinium Capital Management and the author of The Foreword to Trade Your Way to Financial Freedom. Of all the good to great traders I've worked with, I'd estimate that 90% fit here, while the other 10% are totally mechanical. Common mistakes. Let's look at some of the common mistakes that each of our 3 trader types might make. No rules discretionary trader mistakes. In my opinion, everything they do is a mistake because they are never following written, documented rules. But here are the most common ones. Entering on a tip or emotion or something that doesn't correspond to one of your well-thought-out systems. Doing anything because of an emotional reaction. Blaming someone or something for what happens to you rather than accepting personal responsibility. Not having a predetermined exit when you enter the trade. Trading so many trades in the same account that you cannot keep track of them. Thinking a setup indicator is a system. Concentrating on the entry for a system, not the potential reward to risk ratio in the trade. Rule-based discretionary trader mistakes. Not exiting when you should be stopped out. Risking too much money on any particular trade. Exiting too soon on emotion. Not following your daily routine. Trading multiple systems in the same account. Trading a system when the market type has changed and you know that the system now will perform poorly. Needing to be right and taking a profit too quickly, or not taking a loss just to be right. Not keeping track of the R multiples and the general performance of your trading system. Distractions. Order execution errors, including pressing the wrong button, position sizing errors. Plus, most of the errors a mechanical trader or a no-rules discretionary trader might make. Mechanical trader mistakes. General programming mistakes. Programming mistakes that overlook contingencies that might happen in the market that a discretionary trader would catch, such as a major change in market conditions. Data mistakes. Electing to override the system and not taking a trade. Errors that might occur, but that don't fit my definition of a mistake. Missing lots of good trades because the rules are too rigid. Trying to fit the system to all market conditions, in fact that's usually a criteria for a mechanical system. Assuming that backtesting results will indicate the results you'll get when you do real trading with the system. How to prevent mistakes. I recommend that at the beginning of each day, you go through a mental rehearsal. Ask yourself, what could go wrong today that might cause me to make a mistake? Here is an example. One of my clients in Europe was a superb day trader. He made huge profits daily trading the stock index futures. One day a local hospital called him. His girlfriend had been in a car accident and was seriously injured. He immediately rushed to the hospital to be with her, forgetting about his market positions. He didn't have actual stops in the market. He exited with mental stops because he felt that was generally safer for him. However, on this day he thought only about his girlfriend. When he was finally informed that his girlfriend would be fine, the market had closed. Later, he checked on his positions and discovered that he'd lost about a year's worth of profits that one day. When I started coaching him, the first thing I had him do was develop a worst-case contingency plan and make sure that every contingency was rehearsed properly. Generally, the better your worst-case contingency plan is, assuming that all your contingency plans are well rehearsed and automatic for you, the less daily mental rehearsal you have to do. When he was finally informed that his girlfriend would be fine, the market had closed. Later, he checked on his positions and discovered that he'd lost about a year's worth of profits that one day. When I started coaching him, the first thing I had him do was develop a worst-case contingency plan and make sure that every contingency was rehearsed properly. Generally, the better your worst-case contingency plan is, assuming that all your contingency plans are well rehearsed and automatic for you, the less daily mental rehearsal you have to do. When I originally wrote SuperTrader in late 2008, market volatility was as high as 10 standard deviations bigger than the norm. As I am finishing off the updated edition, in May 2010, we just had a day in which the Dow Jones dropped 1,000 points in minutes, only to recover about 60% of the loss within minutes. Many people got stopped out of long-term positions because of that short-term down move. Both the mini crash and subsequent recovery have almost a zero probability of occurring if market volatility is normally distributed. But they occurred! If you are not prepared to trade in these sorts of conditions, your account could experience a disaster. Similarly, who would have imagined that the U.S. stock market would close for a while because the World Trade Center was destroyed and the New York financial district was full of rubble? Did you predict that one? Would you be able to predict that a squirrel could chew on wires in your attic and disrupt your trading? These things happen, so prepare for it. And are you aware that the New York Stock Exchange was once closed for a considerable period of time because the United States feared that other countries would make a run on our gold? The theory was that foreigners might accomplish that through the U.S. stock market. As a result, the government simply closed down the stock market for a while. So these are just a few examples to justify the belief that anything is possible and you need to be prepared for it. Thus, I recommend that everyone go through a daily mental rehearsal. Ask yourself, what could go wrong today to cause me to make a mistake? Become creative and think of everything. For everything you come up with, rehearse how you'll perform to make sure that it has a minimal impact on your trading. One day you might meet that big losing trade in the markets that has your number on it. Wouldn't it be a good idea to be prepared for it ahead of time? Increasing your efficiency from 90%, that is, one mistake every 10 trades, to 98%, that is, one mistake every 50 trades, could double your return rate or more. How? Not to repeat mistakes. There is one more task that you should consider doing on a daily basis. I call this task the daily debriefing. It is designed to ensure that you do not repeat mistakes, where again a mistake means not following your written rules. At the end of the trading day, ask yourself a simple question: did I make any mistakes? If the answer is no, pat yourself on the back. If the answer is no and you lost money, pat yourself on the back twice. Good job, you followed your rules. However, if you did make a mistake, your new task is to make sure that you never repeat it. Ask yourself, what sorts of conditions were present when I made my mistake? When might they occur again? Once you've answered these questions, the task becomes a matter of mental rehearsal, which we discussed earlier. Come up with something you can do to make sure you don't repeat that mistake under those similar conditions, or any other conditions for that matter. Once you come up with the solution, rehearse it in your mind a number of times until it becomes second nature to you. In my opinion, it is essential that you do this task every day. A few minutes each day on this task alone, along with effective solutions, could end up increasing your returns by 20% to 50% each year. Make more consistent profits. Keep it simple. Up until this point, our focus in Part 5 has been on avoiding mistakes. As we conclude this final section of the book, I want to close with some discussion directly related to the simplest and most common goal of all profit. The first lesson and first step I'd like you to incorporate applies to many things in life, including anything you might do in trading or investing. Keep things simple. The more you try to make things complex, the harder it will be for you to be successful. Keeping things simple works both in life and in the markets. Your mind has a conscious capacity of only about 7 chunks of information. You cannot hold any more than that in your consciousness. Have someone give you a series of 10 two-digit numbers, and you'll probably find that you have trouble remembering more than 5 of them because of this limitation in capacity. If you attempt to do complex things with the market that require you to use more capacity than you have, you'll probably fail. Keeping it simple doesn't mean that you can't use a computer to sort through the vast amount of information available about the market. On the contrary, I highly recommend it. However, it means that your methodology and your daily tasks do not have to be rocket science. In fact, the more you try to do, the less likely you are to succeed. I did a psychological profile of a broker trader who ranked in the bottom 1% of all the investors who had taken my psychological test, the Investment Psychology Inventory Profile. He had high stress, a lot of internal conflict, poor organization, no system, a negative attitude, and probably everything else you could name. I then did a 10-minute consultation with him, but he really needed several days. The key issue for him was how overwhelmed he felt by everything that came across his desk. How could he find good stocks when there were so many stocks? How could he follow any plan when his clients all had conflicting goals and motivations? His life was a mess. This broker needed to do a lot of psychological work. His life was in chaos because his mind was in a state of chaos. Simplify the chaos in your mind, and you'll simplify the chaos in your life. You can start doing that by deciding what you want in life, that is, your dream life, and then focusing on only 1 or 2 simple goals from that dream life. Second, he needed a simple system to track his own trading, preferably a long-term system that gave him only a few signals each week and required that he look at the market only after the close. That way, his personal decisions had to be made only once each day, away from the chaos of the market. That system could be something as simple as buying on a 110-day channel breakout, using the weekly volatility as a worst-case exit, trailing it from the close as a profit-taking stop, and not risking more than 1% of his equity on any trade. In his case, he needed to do a survey of all his beliefs about himself and that market. From that survey, he could begin to design a trading method that fit him. These are all simple steps. Success comes from following simple steps. When you understand that and practice it, your performance will improve dramatically. Miscellaneous ways to make money in a trading business. You can grow your business, especially when capital isn't the problem. Instead, your problem is finding the best use for your capital. When you think about these methods, they may seem obvious, but most people don't think about them enough. Here are the key ways you can grow your business. 1. First, develop new, improved trading systems. Each system can help you make more profits, especially if it is not correlated with the other systems. Continue to conduct research to find new systems that can become new profit centers for your trading research. By the way, some of your systems may stop working in certain market conditions, so it's always good to have more systems in the pipeline. 2. Second, find more markets in which to apply each system. Let's say you develop a great system that works on the S&P 500 index. It gives you 5 trades a month and has an expectancy of 2 hours. That means that on average you probably can make 10 hours from that system each month. But what if the system also works on other major stock market indexes with the same results? If you can add 10 more indexes to trade, you may be able to make 100 R each month. 3. Third, add traders. Each trader can handle only so much work and so many markets effectively. Let's say a good trader can trade $50 million effectively. When the total goes above that level, your experience is that the trader's effectiveness seems to drop off. One way to grow your business is to have more traders. 10 good traders now may be able to handle $500 million effectively. 4. Fourth, make your traders more effective at what they are doing. Let's say a trading system generates an average return of 40% each year. You can measure the effectiveness of a trader by the number of mistakes that trader makes. For example, a typical trader may make 20% worth of mistakes each year on a 40% system. That kind of trader, at 80% effectiveness, would allow you to generate 32% from the system. But what if you could make the trader more effective? What would happen if you gave your traders effective coaching that could reduce their mistakes to 5% each year? That amounts to a 75% increase in effectiveness per trader per system per year. You can expand a trading business immensely through coaching that allows your traders to become more effective. 5. Fifth, optimize your position sizing strategies for meeting your objectives. To do that, you must take each of the following steps. Clearly determine what the objectives are for your business. Many people and many firms do not do this task well, if at all. Determine the R multiple distribution generated by each of the systems you use. Simulate different position sizing algorithms to determine which of the thousands of possible algorithms will meet your objectives most effectively. Apply that algorithm to your systems. For example, suppose you want to make 200% on your capital allocated to a particular system. You have a system that generates on average 70 R each year. If you risk 1% of your allocated capital per trade, you may find that you can make 70% per year from the system. However, if you increase the position sizing risk to 3%, you may find that you can make the 200% you desire. Of course, increasing the position sizing risk will increase the potential drawdowns. You need to be fully aware of the downside to such changes. All these factors can be multiplicative. For example, suppose you have 3 traders, each trading 2 systems in 3 markets. Each system makes about 60 R per year per market. But the traders are only 75% effective in trading them. This means that they make about 15 Rs in mistakes per system per market per year. Let's look at what is generated for the company. We have 3 traders times 2 systems times 3 markets times 45 R. If you multiply these out, you'll find that the company generates 810 R each year. Now let's look at the effect of the various changes we could make. First, what if we added 3 more traders? We might be able to double the total return to 1,620 R. Second, what if we added 3 more markets for each system? We might now increase the returns to 3,240 R. What if we added 1 more system per trader? We might now increase the return to 4,860 R. What would happen if we increase the efficiency of our traders to 90%? Which we might have to do for them to handle the extra work, which was blind A. We'd get an additional 20% more profit, and now be at 5,832 R. Finally, what if we made our position sizing method more effective to increase our profits another 50%? Well, you get the idea. No business would be able to do all of the things I've suggested at the same time. But what if you could do a few of them? What would be the impact on your bottom line? If you are considering some of these changes, concentrate on trader efficiency and on more effective position sizing methods to meet your objectives. Avoid making predictions in the market. Most people make a big deal out of market prediction. They think they need to be right 70% of the time or more to pass the exam that the market gives them. They also believe that they might get an A if they could be right 95% of the time. The need to predict the market stems from this desire to be right. People believe that they cannot be right unless they can predict what the market is doing. Among our best clients, I have traders who continually make 50% or more each year, with very few losing months. Surely they must be able to predict the market very well to have that kind of track record. I recently sent out a request for predictions, and here's what I got back from some of the better traders. Trader A: I don't predict the market, and I think this is a dangerous exercise. Trader B: these are just scenarios. The market is going to do what the market is going to do. I got these comments from them despite the fact that I was not interested in any of their specific opinions. Just the consensus opinion. How do they make money if they have no opinions about what the market is going to do? There are 5 critical ingredients involved. 1. That they follow the signals generated by the system. 2. They get out when the market proves them wrong. 3. Miracle. They allow their profits to run as much as possible. That means they have a high positive expectancy system. 4. They have enough opportunity that there is a greater chance of realizing the positive expectancy in any particular month, and little chance of having a losing month. 5. They understand position sizing strategies well enough that they will continue to be in the game if they are wrong and make big money when they are right. Most traders, including most professionals, do not understand these points. As a result, they are very much into prediction. The average Wall Street analyst usually makes a large 6-figure income by analyzing companies. Yet very few of these individuals, in my opinion, could make money trading the companies they analyze. Nevertheless, many investors believe that if analysts tell them the fundamentals of the marketplace, they can use that information to make money. Others have decided that fundamental analysis doesn't work. Instead, they have chosen to draw lines on the computer or in a chart book to analyze the market technically. These people believe that if they draw enough lines and interpret enough patterns, they can predict the market. Again, it doesn't work. Instead, cutting losses short, riding profits hard, and managing risk so that you continue to survive is what really makes you money. When you finally understand this, at a gut level, you will know one of the key secrets to trading success. You cannot ignore the fundamentals. Quite often people make great progress psychologically, but when it comes to some of the fundamental issues that we teach in trading, they ignore them and say, I don't understand. Most people's response is to ignore the fundamentals rather than do whatever is necessary to increase their understanding. Here is a brief quiz on some key elements that I consider absolute fundamentals for all traders. You must understand these elements if you want to compete as a successful trader. Answer these questions before you read the answers in the next section. The quiz. 1. You buy a stock for $25. You want a 25% trailing stop. Where is your initial stop? 2. The same stock moves as high as $40 and then goes back down to $37. Where is your stop? 3. You have a $25,000 account and don't want to risk more than 1% of your account on that stock. How much of your account can you risk? 4. In light of your answers to questions 1 and 3, how many shares did you buy? 5. You buy another stock for $38, but this time your stop is only 50 cents away. How many shares can you buy to risk only 1%? 6. Ericliness. You think that's too many shares, and so you want to base your stop on the volatility. The average true range over the last 10 days of the stock has been $3. You decide to base your allocation on volatility. How many shares can you buy? 7. Since your stop is still at 50 cents, how much are you risking on this position? 8. What's your total investment amount for the first stock and for the second stock? How is this different from risk? 9. What is the variable that accounts for most of the performance variability you are likely to encounter, assuming that you have your psychology together? 10. What have I defined self-sabotage to be? Bonus question. You sell the first stock for $50 or a $25 profit. What is your R multiple on it? In other words, your profit is what multiple of your initial risk? The answers. 1. Your stop should be the current price times 0.75 or $18.75. If you subtract 25% of the price from the current price, you have your stop, and that's equivalent to 75% of the entry price. Give yourself 10 points if you got it right. 2. You have a 25% trailing stop. That means that each time the stock makes a new high, or closing high if you prefer, you take 25% of that as your stop. This is your new stop. Thus, the prior high was $40, and your new stop is 75% of that, or $30. When the price moves down, you do not change your stop. Give yourself another 10 points if you got it right. 3. Your risk is 1% of $25,000, which is $250. Give yourself 10 points if you got it right. 4. Your risk is $6.25. If you divided your risk per share into your total risk allowed, $250, you would end up with 40 shares. Again, give yourself 10 points for a correct answer. 5. Since your risk is only 50 cents, if you divide 50 cents into $250, you end up with 500 shares. Give yourself 10 points if you got it right. Times. Here you divide your 1% risk, or $250, by $3 per share. Your answer is 83.33333333 shares. Round down to the nearest whole share, and the answer is 83. Give yourself 10 points if you got it right. 7. You actually are risking 83 times 50 cents, or $41.50. Give yourself 10 points for that one. Your allocation went down because it was based on volatility, but your stop stayed the same. 8. In the first example, you bought 40 shares of a $25 stock. Your total risk was $250, but your total investment was 40 times $25, or $1,000. Notice that you have a 25% stop, and that your risk is 25% of your investment. Give yourself 3 points for that one if you got it right. In the second example, you either bought 500 shares based on risk for a $19,000 investment, or you bought 83 shares based on volatility for a $3,154 investment. Either one is acceptable, and so if you answered one of those correctly, give yourself 3 points. Total investment is the number of shares, that is, 40, multiplied by the total cost of the share, that is, $25. In contrast, risk is the number of shares, that is, 40, multiplied by how much you are willing to let the price drop before you exit, that is, $6.25. Addition. Give yourself 4 points for this answer. 9. Position sizing strategies. Give yourself 10 points if you got it right. 10. Repeating mistakes, based miss. Give yourself 10 points if you answered correctly. Bonus question. If you sold the stock at $50, you made a profit of $25. That's 4 times your initial risk of $6.25. And so you made a 4R profit. Give yourself 10 more points if you got it right. Thus, your total score could be as high as 110. The score. If you scored 100 or better, your understanding of these fundamentals is excellent. Keep up the good work. If you scored 80 to 99, you need a little work. Figure out where you are weak and do some homework. If you scored 60 to 79, you need a lot of work. Again, figure out where you are weak and make the effort to understand the material. If you scored 59 or less, it might be because you are new to trading and these principles. If that's the case, you have significant work to do. If you've been studying this material for some time and still got 50 or less, perhaps trading is not for you. End of part 5. End of book. Thanks for listening. I greatly appreciate your support, so please like, share, and subscribe. Thank you.